crisis is concerned. We had seen global leaders, including U.S. Secretary of State Marco Rubio, as well as the Russian counterparts as well, both reaching out to India and Pakistan, asking for a de-escalation of the situation, as well as calling for a peaceful resolution, urging both parties to look at a dialogue to come to some sort of a consensus. But having said that, there is, as I said, tough talk on both sides. This is a sign of escalation of the military conflict, and clearly the markets will not be taking it very well. We saw the Pakistani stock index today declining to a 5-month low. The Indian stock markets were also pretty weak in trade today.
Ruchi, we see U.S. officials imploring restraint when it comes to this conflict. What are we hearing from Beijing?
Well, China has condemned these attacks, and remember, as far as India is concerned, various people have asked India and Pakistan both to refrain from escalating this crisis further. But having said that, India has always maintained. In fact, there was a mediation offer from Iran as well, and India has said that that Kashmir is an internal matter of India. They will look to steer clear. So India has not responded on the commentary that came in from China as well. But given the fact that China and Pakistan have had close ties in the past, China has said that they are monitoring the situation very, very closely.
Richie, whenever you have two nuclear powers engaged in this kind of action, clearly people get nervous for obvious reasons. Back in 2019, I think we all remember a similar period of tension as well. Can you describe for us what happened that time around and why we de-escalated things so quickly, and whether things are different this time?
Last time, when the incident happened, things moved very quickly. This time, India took a lot more time than 2019. Also, as I said, this time we've seen that the strikes were deeper into the Pakistani territory, and which is why this time the conflict that we're seeing is very different. Having said that, India is at a much stronger position at the current moment on the world stage as far as what it had back in 2019. So things are very, very different this time around. We're seeing tough talk from both sides. India has had vowed to punish the perpetrators of the Kashmir attacks, and now after India struck those military targets, through its military, we're seeing Pakistani side now readying to act as well. So we will have to really wait and watch out to see how it really plays out.
Ruchi, appreciate the update. Thank you. Ruchi Bhatia there of New Delhi, following that tension between Pakistan and India. India calling the action precise, restrained, and designed to avoid escalation. I'm not sure Pakistan sees it the same way.
No, they definitely don't see it the same way, and they're saying that they downed some of these Indian fighter jets. What you see, though, from the global community is that they want to have this restraint. There's also another brewing issue in behind the scenes. This is access to resources. India basically saying there's this water treaty, and they're basically saying they don't want Pakistan. They want to get rid of Pakistan from this water treaty. If that continues and there's drought, there's going to be a lot more tension within this region.
We'll keep you on top of the story right here on Bloomberg TV with an update on stories elsewhere with your Bloomberg Brief. Let's cross over to Yahira. Hey, Yahira.
Hi, John. China's central bank cut its policy rate and lowered the amount of cash lenders must keep in reserve. The moves are meant to help stimulate the world's second largest economy amid its trade war with the U.S. The announcement came hours after China revealed it would hold its first trade talks with the U.S. this weekend. Meanwhile, Rivian says full-year deliveries will decline more sharply than it anticipated a month ago, citing the impact of tariffs. Still, the EV maker expects to achieve a modest full-year gross profit. Rivian stockpiled EV batteries from suppliers in Asia ahead of Trump's tariffs to ensure supply continuity. And Inter Milan is back in the Champions League final after a nail-biting second leg against Barcelona. Inter was seconds away from elimination before scoring the tying goal in extra time. They completed the comeback in the 99th minute to seal the win in the 7-6 aggregate victory. They'll face either Arsenal or PSG in the final. I can see why you were up late, John.
Yahira, thank you. Frame it. End the season. Everyone else should retire. We should just have a 7-game series of Inter versus Barcelona. No one's going to beat that for the rest of the year.
This is it. Well, yeah, you kind of have kind of blown the energy that you have for this game, right? Basically, how much can you have left? Is this the same as watching the Masters for you, or is it completely
that's a different vibe. No.
It's not like they do this.
This is too stressful.
This isn't like goal.
The Masters is sanctuary, okay? It's a sanctuary. Okay, San Siro's not that. I've been to that stadium many times.
Good job.
Yeah, nothing like that. Believe me. The sound yesterday, absolutely deafening. Just absolutely fantastic. Just fantastic. Up next on the program, the art of the deal.
We're going to put very fair numbers down, and we're going to say, here's what this country, what we want, and congratulations, we have a deal. And they'll either say, great, and they'll start shopping, or they'll say, not good.
Up next on the program, Francis Donald of RBC joins us next to talk through the economic risks going into the Federal Reserve decision later on this afternoon. From New York, this is Bloomberg.
Incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why, but we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Bouncing back from a two-day losing streak on the S&P 500, positive by 0.6% on the Nasdaq, up a similar amount on the Russell, up by 1 percentage point. Under surveillance this morning, the art of the deal.
We will sign some deals, but much bigger than that is we're going to put down the price that people are going to have to pay to shop in the United States. Think of us as a super luxury store. We're going to put very fair numbers down, and we're going to say, here's what this country, what we want, and congratulations, we have a deal. And they'll either say, great, and they'll start shopping, or they'll say, not good.
Sounds simple, doesn't it? And here's the latest this morning. President Trump remaining optimistic on tariff negotiations ahead of US-China trade talks later this week. Francis Donald of RBC writing, the uncertainty theme is the new normal. What really keeps us up at night is the potential for supply shortages or empty shelves, leading to extended demand-supply imbalances. Francis joins us now for more. Francis, welcome to the program. A lot has changed. Certainly a lot has changed since the Fed last met on March 19th. How much has changed for that committee as they convene and put out a decision later on this afternoon?
Well, it seems like a lot has changed when you look at the headlines, but the data itself hasn't changed very much yet. And that is the big challenge for this central bank and all central banks globally, which is that it's too early for them to actually see material impact from a lot of these Washington policies and global policies that are occurring at the same time. So, John, I gotta say, I can't remember the last time I spent less time thinking about a Fed meeting. Some of that is cyclical. This is a Fed that's indicated it probably needs to wait and see. But a lot of it is structural, and that is that will matter most to the U.S. economy isn't whether the Fed cuts 1, 2, 3, or more times this year. It's what happens with trade policy, what happens with immigration policy, and do we have some dysfunction in the supply chains that leads to more problematic developments this year?
Francis, that sets us up perfectly. 1:30 p.m. Eastern Time, we will have live coverage of that meeting that you could not care less about. I want to go to the theory that you put out there that I thought was really important, which is it's less important this sort of binary outcome, recession or not recession. It's the idea of some sort of stagflation that potentially could be more pernicious for this economy. Can you explain why you think that's an important distinction to talk about at a time where most people agree the economy is slowing?
Well, economists get divided into two camps, especially right now. Are you in the recession camp or no recession camp? And technically, if you look at RBC's forecasts, we don't have 2 quarters of negative GDP back to back, although that's very much a real risk. Regardless, we have very slow growth with a rise in the unemployment rate and a rise in inflation. And sometimes I think saying, slightly negative GDP is probably indistinguishable from slightly positive GDP. What will be problematic this year for the United States is not whether we get 1, 2, or 3 quarters of negative growth or slightly positive growth. What we're watching are some of these bigger trends. A potential labor shortage that's coming through. America does not need jobs. America needs workers. What's happening with that electrical grid, which is really feeling a lot of tension? Can we actually reshore manufacturing activity? And as much as, of course, all economists are concerned about the price increases coming from tariffs, our eyes are firmly on, is this going to create supply chain disruptions? And one of the lessons from 2020 is that when you start to mess with supply and demand dynamics within supply chains, when you have ships that stop coming to shores, it isn't a 1 month fix. Sometimes it can take months or years to recalibrate supply and demand. And so that's what keeps me up at night right now. Not just are we going to see a mechanical increase in price because of tariffs. All of those factors are going to be more important to the U.S. economy this year than whether or not you get slightly negative or slightly positive GDP growth. So recession, not the camp that you should be putting economists in. Look for those underlying themes that are really dominating their underlying narratives for the U.S.
Are you sleeping better knowing that the U.S. and China are talking or planning to talk, or do you think that it's too late, that those ships that have not been floating over to the U.S. already have really risked the idea of supply chain disruptions, as you were just talking about?
Well, we'll sleep a little bit better if we can all collectively, as investors, economists, financial watchers, realize that the worst of that uncertainty is behind us. But I'm of the view that this uncertainty has long legs because it's not just about U.S.-China tariffs. It's not even just about the U.S. versus the rest of the world building that tariff wall. There's an enormous amount of policies that are still potentially very game changer for the U.S. economy that's impacting American and global companies. They have to do with the immigration policy. Are we getting deregulation? What does tax cuts do? Companies I talk to are asking me about SNAP benefits and student loans. There's an enormous amount of change happening under the surface. Meanwhile, as we know, assets are not moving as they typically do. Those correlations are breaking down. That's having an impact. And we're still missing some of what is the internal strategy coming out of Washington? So yes, it would be nice if we've seen peak uncertainty behind us. And as I always say, markets are second derivative beasts, so that will matter. But there's probably
long legs and kind of deep tentacles on this uncertainty within the U.S. economy. It extends broader than whatever headlines we're going to get this weekend around U.S.-China trade.
Francis, even if we see the tariff rate come down from 145%, and let's just say for argument's sake 60%, are you still concerned about supply shortages?
Well, absolutely. This is a structural recalibration of a trade relationship. And think about a business on the ground that is trying to figure out what is the right calibration of content that I should be sending to the United States. This is not going from 145 to free trade. This is still a wall that is being built around America that's going to require an extensive amount of recalibration. And this is the issue, is that we are undergoing a structural recalibration of U.S. trade with the rest of the world. That's not easy for companies to figure out. And so when I go to bed at night, I'm not looking at Fed commentary anymore. I'm tracking ships from China to the west coast of the United States, because that could be one of the core themes heading into this year, is what that calibration looks like and just how difficult it is to find the exact point of supply and demand meeting.
Hey, Francis, you're one of the best, and you're not alone. Francis Donald there of RBC with the latest. It's very difficult to forecast in this environment. Depending on what kind of company you are, it can be almost impossible. For the Walt Disney Company, check them out this morning. This is rare. Haven't seen much of this over the past few weeks. A beat and a raise, thanks to the theme parks, thanks to streaming. And this from Bob Iger. We remain optimistic about the direction of the company and our outlook for the remainder of the fiscal year.
So Bob Iger comes back. I wonder how much succession planning there'll be in this discussion, because right now it seems like he's doing pretty well. They're looking at revenue that beat for both entertainment, for even the streaming division, as well as the ESPN go direct to market later this year. They also are building a new theme park. This is a business that seems relatively immune to some of the other discussions that we have. I want to hear the commentary at 8:30 a.m. Eastern about how much they feel the uncertainty from tariffs and global tensions.
Stock is up at the pre-market by close to 6%. We'll have more on that in the next hour. Coming up next, Priya Misra of JP Morgan, Bloomberg's Tyler Kendall, Geetha Raghunathan of Bloomberg Intelligence, and former Kansas City Fed President Thomas Honig from New York City. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Doesn't take a lot of good news to see this market pain trade higher.
I think the markets will see through a lot of this.
You just have to be patient and wait for the moments when favorite names show you opportunities.
It's a little difficult to see how you can really get that next leg up.
If you want to de-risk from the U.S., there's not some amazing oasis of, place to park your money.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 bouncing back from a two-day losing streak on the S&P this morning. We're positive by around 0.6%. On the NASDAQ, up 0.6%. Also on the Russell, up by 1 full percentage point. Your day ahead, your week ahead looks like this. Later on this afternoon, a Federal Reserve decision and Chairman Powell news conference, and tumbleweed. Hardly anyone's talking about it. Quote of the morning came from Francis Donald of RBC. I can't remember the last time I spent less time thinking about a Federal Reserve decision. The main event for many of you might be 10 a.m. Eastern time when we hear from the Treasury Secretary Scott Bessent on Capitol Hill as the U.S. and China plan talks.
This is what even the Federal Reserve is probably watching more carefully than each other's rhetoric, because they want to understand what the trade framework is going to be like in the United States. There has been a softening in terms of the rhetoric between China and the U.S. How long it takes to make some sort of deal remains to be seen. What is the status of some of those other deals with other countries also remaining to be seen. The Fed is just as curious and just as dependent on that as they are what they are looking at each other and discussing economics.
This is an important moment because it's the first significant step we've seen in terms of a sign of a thaw in this trade war between Beijing and Washington. But what you heard from the Treasury Secretary last night, and I'm sure he'll elaborate on this today when he's in front of Congress in this hearing, is that this is not a deal. This is a step towards de-escalation. So what does de-escalation look like? Well, if you ask Kellyanne Shaw, who sat at the table with the Chinese during phase one in Trump's first administration, she thinks potentially the rates could come down, 145%, but where's it coming down to? That's the question.
You're on the money, I think. This is something we've all got to address going into the weekend. Talks about talks. These are talks to arrange negotiations. It's not the start necessarily of negotiations. And to do that, I think the Chinese have been clear over the last few weeks. If you want to talk about this, if you want real negotiations, those tariffs need to come down.
In the meantime, CEOs are saying it's really nice you guys are talking. So glad that you've taken some of the worst case scenario off the table. How do we plan? How do we decide exactly what to order? How do we know exactly when this is going to be alleviated with contours of even a concept of a plan? How do we even understand what the asks are that are feasible on both sides at a time when the Chinese government is clearly girding for potentially a protracted negotiation with a new round of stimulus? This is the reason why it is surprising to see that Disney come out and upgrade their forecast. And you see others like BMW saying things are looking softer, but this probably won't happen. How much as a consumer and how much as a CEO can you take any of this with any kind of definitive?
Well, there needs to be strategic uncertainty, according to the Treasury Secretary. He said everything's on the table. I'm never going to come out here and negotiate in public because that will mean we're losing leverage. But the reason why this is such a positive development in terms of thawing between Beijing and Washington is because the president has come out and said a number of times he's spoken to Xi Jinping, and everyone sits around the table and wonders, is that really tangible and true? Because the Chinese have said there's no negotiations or talks on any level. Well, now there are actually talks. So the direction of travel from here at least seems to be positive.
The range of outcomes is incredibly wide, and it makes it very difficult to set policy. Chairman Powell, over to you a little bit later this afternoon. Equity futures on the S&P positive by 0.7%. Early days, but a bounce back from 2 days of losses on the S&P. On that, we'll catch up with Priya Misra of JP Morgan in just a moment. We'll talk to Geetha Raghunathan of Bloomberg Intelligence, reacting to Disney earnings, and the former Kansas City Fed President Thomas Hoenig counting down to an FOMC decision later on this afternoon. We begin this hour with stocks rebounding, investors optimistic as US-China trade negotiations are set for this week. Priya Misra of JP Morgan writing, we are in a giant game of chicken between the market, the administration, and the rest of the world. Maybe great deals are just around the corner. Priya joins us now for more. Priya, good morning.
Morning.
Are they just around the corner?
I think that's what the equity market's hoping, not realizing, or maybe hoping that that doesn't happen, that trade deals or even an agreement in principle with all our trading partners is incredibly hard. It's going to take a while. The administration saying this is strategic uncertainty, which tells you, remember when we were thinking maybe April 2nd was peak uncertainty? Well, okay, maybe it was peak, but we're not that much lower. This is a plateau of uncertainty that the economy, it's going to weigh on the economy. It's very non-linear. You can handle some time of uncertainty. When that just goes into weeks and months, and you know, Congress is also sort of dealing with the fiscal side. So there's uncertainty on immigration, there's uncertainty on trade. When all that uncertainty starts to weigh on the economy, I think the equity market's hoping, well, the deal's right here. At least we know they're talking. That's good news. We weren't sure if that was happening. But it's going to take a long time even to get that agreement in principle. So we don't know how long it'll take, and we don't know the end point. The end point is not where we were on, at the start of this year.
No question, it's a policy shock. The ECB's decided it's a disinflationary shock. They've cut rates. The Chinese have done the same thing overnight. The Federal Reserve, when they have to address the same question, what kind of a shock is it for them?
I think Chair Powell's is going to have to master the art of saying nothing today. So what kind of shock is a great question. I think it's a supply shock, which is very hard for monetary policy to address. But the Fed really can't commit to it. It might morph, I think it will, from a supply shock to a demand shock. When you get prices going up and the consumer has to pick between dolls or anything else and services, do they cut back on services? The US is a service-led economy, but look at the data right now. If you take a step back, the hard data is okay. Payrolls are strong, inflation is still above target. So I think and financial conditions have eased in the last month, or at least in the last few weeks. So I think the Fed will say we have no urgency. They've already cut rates. They've taken the preemptive steps. I think people are looking for them to be preemptive. They were already preemptive last year. They've taken rates down. We're at 4.5. They're going to keep it here until they figure out what's the shock, what's the policy offset. Do we get a big fiscal stimulus deal? In which case, they don't need to address the supply shock. So I think for the Fed, it's trying to, I think clarify the reaction function. That's the most they can do. That look, if the economy slows down, we'll respond. We're not there yet. We're watching, like everyone else, we're watching everything and we'll respond appropriately.
The reaction function. This is really interesting to me because right now we don't have a clear sense of what the reaction function is and what data dependency means in a new world where data is incredibly backward looking. And this economy depends on people having $30, not necessarily $2. And when you start to have that come to fruition, how quickly could you see it manifest in the actual hard data as a demand shock rather than the much more quickly moving supply shock that translates into higher inflation that could come as soon as next week?
Right. So I think that's the question we're all grappling with. That, we've not seen it in the hard data. How long does it take? I don't think it's that long. I do think it's a little more delayed because we learned from the pandemic. Companies learn from the pandemic, consumers. I've not done any early shopping, but people have. I think this front loading, you're seeing it in the data. You're seeing it in the trade data. You're seeing it in, companies sort of picking up or piling inventories. So the lag might be a little longer. What I'm watching is what do companies do? Do they pass on that cost? Do prices go up? Do we see it next week in CPI? If prices are going up, that's when consumers have to decide where do they cut back, because real incomes are not really growing. So maybe it shows up in prices first, and then consumers start to pull back on demand. Or do companies say our margins, can afford to take that price increase? And in that case, when margin compression starts to build, do they start to lay off people? So I think we're going to have to watch consumers. We're also watching companies. What do companies do? I think hiring freezes are happening. Do the layoffs start? And so it's the next few months. I don't think we're waiting till fourth quarter. I think the next few months you'll either see the consumers pulling back or you'll see companies trying to keep some margin and having to cut costs elsewhere. And I guess the interplay of that will show up in the economic data, which the Fed will respond to.
It seems like the Chris Waller reaction function is to look through the price increases and look straight to what could potentially happen with the demand shock, what could happen to the labor market. Do you expect to get a better sense of whether that's consensus today at a meeting that Francis Donald is going to sleep through?
I don't think we'll get such a clear signal from Chair Powell, because and I think there's a little bit of path dependency. We just lived through a transitory supply-driven pandemic shock becoming a demand shock because we had a lot of fiscal stimulus, and it fed through into wages and inflation expectations. So I think what we'll hear from Chair Powell is, we haven't seen it in the data, we're watching inflation expectations, and so, which is why I struggle with them being preemptive. But I do think when they see that data, and I think it's a matter of months, they can be very aggressive. The Powell-led Fed doesn't necessarily move in 25 increments. They started hiking late, and then they went in 75 increments. I think they're going to start almost by definition a little late because they're waiting on data that is lagging. But once they realize it, and I think that's what the market's pricing in. The market's pricing in a scenario where they don't need to do anything because maybe we get these quick deals, credible quick deals. Or the scenario where the economy actually slows down and the Fed then aggressively cuts. I think we're pricing in this bimodal distribution, which is why the rate market's pricing in these rate cuts. I think actually the market can price in more if you start to see that hard data deteriorate.
You say they're going to be late. I can think of one person who doesn't like people being late, particularly Chairman Powell. It's the President of the United States. That this afternoon is going to be somewhat interesting.
Absolutely. I think you're going to get a live drip feed on Truth Social of him jawboning, or potentially if he talks to the press, he's going to say Chair Powell is wrong and should be cutting interest rates, but that's not going to be new. We've heard this all along from the president. The one thing that he has come out and said is he does not want to actually get rid of him, even though he has in the past used the word termination.
Do you think this comes up in the news conference today, or is this yesterday's news?
I'm sure it'll come up, and I'm sure Chair Powell's prepared to say, we're apolitical, we're not even thinking about this, because there is an argument, which I don't love, that because he's getting this pushback to cut, that Chair Powell may not cut. No, I think they're looking at their mandate. The mandate, I agree, it's backward-looking data, but the hard data is not suggesting that they need to cut here. So he's got an easy pass. I think it can get a lot harder if the unemployment rate starts to rise and inflation starts to rise. I think then he's going to have to explain why he's not cutting rates.
But juxtapose this moment in time to before the election when he cut rates. Why did he do it then?
I think, the labor market was showing signs of weakness. Now, I'd like to give the Fed credit that just because they cut rates, the labor market sort of recovered. No, I think, turns out that was a sort of noise in the data. We had those 3-week payroll reports, and Fed funds was at 5.5. So they cut rates to take some of that edge off the economy, to move rates lower. They didn't need to do more. The long end sold off. So I think the market pushed back and said, no, we actually don't need to cut a lot more. The Fed heard it. So I think that, I don't think is political. He'll absolutely be asked that. But I think as long as he's not fired, I think it's a free country. People can push back.
It's a low bar, Priya.
Right.
As long as he's not fired. Priya Misra of JP Morgan's going to stick with us. We need to talk about the bond market with her. Only last week, she said the 30-year bond was a risk asset. We'll talk about how risky this bond market is a little bit later this morning. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. A check on Disney shares. Those are up 6% in the pre-market after reporting fiscal second quarter results that beat Wall Street estimates. Disney is benefiting from faster than expected growth at its theme parks and its streaming business. And because of that strong performance, Disney raised its guidance for the full year. Meanwhile, Shein and Temu both saw double-digit sales declines the week after they raised retail prices to cover the cost of U.S. tariffs. The duties are also having an impact on the company's business plans. Shein is slowing its IPO plan, and Temu is planning to switch to a local fulfillment model. And Transportation Secretary Sean Duffy says it's safe to fly into and out of Newark Liberty International Airport. This comes after air traffic controllers lost contact with aircraft for about 90 seconds last Monday. Speaking at the White House, Duffy said the agency will focus on improving traffic at the airport to give travelers more options. That's your Bloomberg Brief. John?
There's certain things that you don't want people in government saying, like when they come out and say the financial system is resilient. When the Treasury Secretary has to come out and say those things,
bad news.
You should just assume it is already resilient.
Correct.
I don't want the Transport Secretary telling me that airports are safe. I just want to assume they're already safe. It's not a good position to be in.
Especially when it's a regular occurrence that has to come after people are receiving crisis counseling as a response to our safe air traffic control system.
Shocking, absolutely shocking. Up next on the program, the US and China breaking the ice.
The world has been coming to the U.S. and China has been the missing piece. This isn't sustainable. As I said before, especially on the Chinese side, we don't want to decouple. What we want is fair trade.
Up next on the program, we'll catch up with Bloomberg's Tyler Kendall and get more thoughts from Priya Misra of JP Morgan on this bond market. Live from New York City this morning. Good morning.
Headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Looking to erase a 2-day slide on the S&P 500. Equity futures so far this morning, just about positive, up by 0.7%. Your scores in the bond market, check out the 10-year. The 10-year, the last time the Fed met, March 19th, 424. Not far off that this morning, 431.40. Yields higher by 2 basis points. No change expected. BNP Paribas, nothing to do. Morgan Stanley's Mike Gapen. The data says the Fed should wait. We mentioned Francis Donald of RBC. Can't remember the last time I spent less time thinking about a Fed decision, so that's your promo for this afternoon. Under surveillance this morning, the US and China breaking the ice.
The world has been coming to the U.S. and China has been the missing piece. We have shared interest that this isn't sustainable, as I said before, especially on the Chinese side. And, 145%, 125% is the equivalent of an embargo. We don't want to decouple. What we want is fair trade.
So here's the latest this morning. The first confirmed trade talks between the US and China set to happen this weekend. In Switzerland, Treasury Secretary Scott Bessent seeking what he calls de-escalation. Joining us now is Tyler Kendall from the nation's capital. Tyler, welcome to the program. Feels like talks about talks. Is it fair to call them talks about talks?
Yeah, hey, John, I guess that's a good characterization of this because it really is going to be all about de-escalation before they can get into any real contours of a trade deal. And Bloomberg Economics cautions that they don't think meaningful tariff progress is really going to come quickly or easily. Now, of course, the optimistic view would be if both sides lower their tariffs on a reciprocal basis to start to jumpstart these discussions. But ultimately, we know that Beijing has called on the U.S. to remove or at least slash significantly its levies on a unilateral basis. And while President Trump has signaled some willingness to lower tariffs on Chinese imports, as the current situation amounts to a trade embargo, Ultimately, we know that this White House would like to see China de-escalate first. That could potentially look like China pledging to boost U.S. imports, perhaps resurrecting some of those purchase agreements under the Phase 1 China trade deal, maybe even perhaps tightening controls when it comes to fentanyl flows, loosening curbs when it comes to critical minerals, things like that. But at this point, it really does remain to be seen what the U.S. needs to see in order to move forward here to those official talks. And officials tell us that's by design, as Treasury Secretary Scott Bessent really contends it's all about strategic uncertainty. But John, to be sure, the other side of this, of course, is that President Trump has threatened that he'll just set a rate and walk away from the table if he doesn't like how negotiations are going. Perhaps we got Beijing's response to that in a statement this morning from its Commerce Ministry, saying that they hope that the U.S. will engage here with sincerity and move ahead with what they called equal consultation.
Tyler, what do we expect from the Treasury Secretary today? He's going to be back on Capitol Hill yet again, but now with some fresh news behind him.
Yeah, no doubt. And no doubt that these lawmakers are going to also want to take a fresh swing at this administration's policies as we do get this update about trade negotiations. Now, he did tell lawmakers yesterday, laid out some goals here, saying that he hopes that about 80 to 90% of our top 15 trading partners will see trade deals by the end of this year. So that was sort of a new timeline that we hadn't heard before. So perhaps we could get even some more concrete details as this administration contends that we could see agreements as soon as this week. The second part of this, though, of course, is going to be about the tax agenda and reconciliation. He's going to be talking to these lawmakers. One of those themes that we are watching closely is whether or not we get any update when it comes to the X date. Treasury Secretary Bessent has said that that updated number is forthcoming, but that they're still working through those April tax receipts. But that's going to be absolutely critical, as you know, Anne-Marie. That will likely serve as that hard deadline for lawmakers to get that reconciliation package through that this White House is banking on.
Tyler, thank you for the update. Tyler Kendall down in Washington, D.C. Priya Misra of J.P. Morgan still with us. Priya, let's build on some of this and unpack it. So on March 19th, we closed around 424 on 10s. This morning, we're around 424 on 10s, despite the fact we had a major policy shock down in Washington, D.C. You know where this is going. Number one question for portfolio managers right now. For anyone who's cross-asset, is the long bond going to provide me some comfort if things go wrong with the economy?
I'm not sure about the long bond. I think the long bond has supply-demand for treasuries as much as the economic fundamentals of where Fed policy is going to be. The 5-year, absolutely. We've been adding any backup in interest rates. We've been adding to the 5-year. Concerns around deleveraging, we've been adding to the 5-year because that's much more levered to essentially Fed cuts and that end point. So we don't have to have necessarily a view, do they start cutting in July or September? What's the end point? I think it's going to be below that 3%. So the 5-year, I think, does provide you that hedge. I think it's a true hedge. The long end, now we're talking about supply, demand, what's the end goal of tariffs? Is it to remove the trade deficit? If it is to remove the trade deficit, the rest of the world doesn't need to hold as much in treasuries. I don't think that's the end goal, but I think the long end has a lot more supply demand. We're also talking about this reconciliation package. It's very hard to get the Medicaid cuts in there. So if Congress doesn't end up doing the cuts, but still manages to do all these tax cuts, beyond the extension, I think that's going to put pressure on the long end. If we have a politicized Fed at some point, inflation risk premiums can rise. So I think there's a lot more going on with the long end. I would stay away from the long end. We like curve steepness, but I think that 0 to 5 years is still rock solid.
What has changed in the past month, or really since the last Fed meeting, that makes you that much less positive on the long end of the yield curve?
April 2nd.
Right, but what about it?
So I think the idea, and I think you all have talked about it, which I think was a great way of saying, is this a shock to the cycle or the system? And is this like a change in the US-led world order, trading order, economic order? I mean, trade is all a lot of us have been talking about trade. The flip side of trade is that the rest of the world buys US assets. And if we're trying to reduce the trade deficit, it means that the net international capital position of the US is going to change. If the rest of the world doesn't need to own as much in US assets, cost of capital is going to go up. It's not just for companies and consumers, for the US government. And at the same time, what are we getting in terms of on the fiscal side? If we were getting significant fiscal retrenchment, I would have said, okay, demand's less, supply is going to be less too. We're not really seeing that. Now, the tax bill is being talked about. So I think April 2nd, I don't view that as necessarily just a negotiating chip and, we'll just get better fair trade deals. and we'll go back to where we were at the start of this year. I think the administration's trying, and I think the damage is already being done. The rest of the world now sees the US not necessarily as a very credible trading partner, and therefore, should capital come back to the US, I think we have to do a lot of work to attract that capital back.
Priya, when it comes to the tax bill, does the Fed need to cut if we get all the sweeteners the president has promised?
Not necessarily, but do we get that? And I think that's why the Fed, and I hope Chair Powell's asked about that how does the tax deal, it's another form of uncertainty. They did see, what resulted in inflation becoming entrenched, I think part of it was fiscal, right after the pandemic. So if we get significant fiscal stimulus that can offset tariffs, the Fed can step back. I don't think we're going to get that, and the Fed will realize it, and then they'll have to cut more aggressively. But we don't know, and they don't know, and so they're just going to try and say nothing for an hour, which is going to be quite.
It's going to be fun, right? Isn't it? Live on Bloomberg TV later on this afternoon. I'm pleased you keep going back to this framework. Is it a cyclical level shock, a cycle level shock, or a system level shock? I think it's really, really important. I don't know. I don't know how great the appetite is in Washington, D.C., to rewire the global system and tolerate the dislocations that could be associated with that. What worries me in between while we try and figure this out is whether international investors behave as if it is a system-level shock and begin to diversify away from U.S. assets.
Which is the reason why the Taiwanese dollar and the fact that it surged caught people's attention. Taiwan is uniquely exposed because of how many U.S. dollar-denominated assets that life insurers have bought, but also because of trade. Are they a leading indicator for what's to come?
Priya, this was really thoughtful. It always is. It's good to see you. Priya Misra there of JP Morgan, counting down to the Federal Reserve decision a little bit later on this afternoon, but not really. A lot of people just think this is going to be an absolute snooze later on this afternoon.
It will be a heavy lift for the journalists who are tasked with asking really good questions that will not be answered, but asking them in a way that makes it sound as though there is some progress being made, because right now there is no incentive whatsoever for these Fed officials and Fed Chair Jay Powell to say anything other than we're just following a world.
If you have to be glued to the TV today, it's going to be Scott Bessent on Capitol Hill. It's not going to be Jay Powell over at the Fed, because there's really nothing he can say, as we've all said. But the markets are dictating what they want to do based off policy. So you need to look what the Treasury Secretary is saying.
Looking ahead to the talks about talks later this weekend over in Switzerland. Up next on the program, Geetha Raghunathan of Bloomberg Intelligence on some big earnings from Disney, a beat and a raise, and some optimism from a CEO, Bob Iger. We haven't seen much of that through earnings season so far. That name is up in a pre-market by 6%.
Thank you. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bring you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Equities are doing okay. Stocks are positive across the board here on the S&P, on the Nasdaq, on the Russell as well. Equity futures on the S&P 500 higher by 0.6%. 2 hours away from the cash open. The opening bell just around the corner with your morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. Disney doing some work to allay concerns of a consumer slowdown, increasing their guidance going forward. Also seeing strong results in the quarter that they reported. Their theme parks, for example, that did really well. Concerned there that there'd be some slowdown because of consumer uncertainty. They're also increasing the price of their streaming services. All of that coming together to lift shares 6.5%. Uber, kind of the opposite problem, not doing enough to allay concerns of a consumer slowdown. That's even though that they increased the guidance going forward. But it's really the quarter that they reported that has the concern. We did see a gross booking slowdown. Now, the company said it's really because of a strong dollar, but even at a constant currency, gross bookings were a 20% increase compared to 24% ahead. So shares down 3.33% this morning. Finally, wrapping things up with CrowdStrike. Now, they reported earnings about 2 months ago, and they were pretty weak, still feeling the effects of that flawed software update that led to a bunch of servers going down across the world. Well, they gave a strategic update today saying that they're going to be streamlining operations, that they'd be letting go about 5% of the staff, or about 500 workers. They'd face a charge of that of up to $52 million. Shares down 2.2%. Also not sure to make of this one, but the CEO also saying that offices would be closed today and tomorrow, and that if you're already in the office, you should probably go home. John.
Okay. Do we know why?
No, there wasn't really a reason attached to that. I don't know if it has anything to do with the layoffs or whatnot, but yeah, the CEO saying go home if you're in the office.
Interesting. All right, we're down about 2.2%. Things you don't want to hear. If you work for a company, right? Go home.
Maybe they're just saving electricity.
Sometimes on a Friday,
honestly, I was about to say, sometimes you want to hear that. It doesn't depend.
If someone says go home in the middle of the week, I don't think that's a good conversation.
You're going to say, please, sir, say it. Well, I mean, this is a question about, maybe electricity bills, maybe...
Friday mid-morning, I'll take that. All right, watch this space. On our radar this morning, India carrying out targeted military strikes in Pakistan in retaliation for a militant attack last month in Kashmir. Pakistan saying it shot down 5 Indian jets in response.
So Pakistan is saying this is an act of war. I am looking at what Eurasia Group South Asia practice head put out this morning, and when it comes to what happens next. And that restraint we're hearing from the places of Washington, Beijing, maybe it's working. He said both sides are nuclear armed. We all know that, which is why everyone is concerned. But he says neither has overwhelming military dominance. Both lack the economic or political interest in a sustained conflict. So these skirmishes tend to die out within 24 to 48 hours. So I think potentially where we are at the end of the week potentially will show where this conflict is going.
And it's not a surprise that the U.S. administration is trying to tamp this down pretty quickly because there's enough going on in the rest of the world with trade tensions, with hot conflicts. This is not one that they really want to see percolate upward.
Yeah, 2 nuclear powers throwing missiles at each other?
Maybe let's not do that.
It's never a good look. Without this news, our next story, you would have seen equities weaker overnight following the last story. This one, though, is the one driving stocks this morning. Treasury Secretary Scott Bessent and US Trade Representative Jameson Greer heading to Switzerland for trade talks with China this weekend. The pair set to meet with the Chinese Vice Premier with a focus on de-escalating trade tensions.
Yeah, talks, maybe. And so we get now maybe the sense that things are at least softening. The idea of taking the worst case scenario off the table, how much is that good for? Right now it's good for a slight rally in markets that have already seen a pretty big boost over the past couple of weeks. How far can this go, though, without greater contours, given the fact that we've already seen the likes of Temu and Shein already see sales declines? It's a real concern already in the works for a lot of companies.
What they're asking, the Treasury Secretary, the President of the United States, is something that most economists argue is good for China. So maybe China will be willing to do these things, rebalance. Maybe they revisit the purchase agreements. I don't know. These all seem pretty easy to me. Fentanyl, address some of that. There was a report that the Chinese are willing to do just that. It's the Chinese demand to the US that I think might fall on deaf ears. And I'm thinking more specifically about restrictions around US technology. That could be the sticking issue. Not in the talks of the weekend. These are the talks about the talks, and maybe you have to move down the tariffs to take a step forward. It's the complete agreement further down the road. It's the sticking points in the complete, fully comprehensive agreement further down the road that we need to spend some more time thinking about.
And it's going to be the most challenging, because that's what China wants, but that's what the U.S. refuses to give into. When Scott Bessent, the Treasury Secretary, talks about decoupling from China, he only wants to decouple in the national security space, high tech, steel, pharmaceuticals, things that matter from a national security perspective when it comes to the United States. But China wants access to all that. So down the line, that's going to be incredibly challenging. Maybe we see the tariff rate drop at the end of this week, but it's going to be months till they get to something more comprehensive.
Companies like AMD putting a price on this, expecting to lose $1.5 billion in revenue this year due to US restrictions on sales to China. The CEO, Lisa Su, remaining bullish about overall demand for AI infrastructure and counting on the debut of new chips to boost sales later this year.
Yeah, and the shares are up because they talked about the insatiable demand for chips and for AI types of technology that really keeps on going. AMD is the one competitor to NVIDIA, although NVIDIA is the big behemoth in the space. I just want to point out that Jensen Huang overnight was talking about how this is a Boeing-sized opportunity that's being lost for them in China. And he's not talking about one plane. He's talking about the entire company in terms of potential sales in China that is going to be eliminated with some of these chip constraints. So how do these companies portray optimism about the AI build-out while also being realistic about what kind of decoupling there could be between the U.S. and China?
And speaking of China and Jensen Huang, when I caught up with him briefly in Washington, D.C. last week when he went in before this meeting with President Trump, he talked about the fact that China is really not behind the United States when it comes to advanced semiconductor. He said they are neck and neck. They are almost right behind the U.S. But when it comes to wanting to make sure they can continue to sell their product, next week is going to be critical. When the president goes to the Middle East, the administration is weighing potentially rewinding some of the Biden administration diffusion rules on how many chips they can sell into certain countries. Potentially, there's going to be more buyers in the Middle East for NVIDIA semiconductors.
Corporate America facing a lot of risks. The Disney company, the Walt Disney Company, did something different this morning. They beat expectations, and then they raised their full-year guidance. The stock is up by more than 6%, and some optimism from Bob Iger. We remain optimistic about the direction of the company and our outlook for the remainder of the fiscal year. Joining us now to discuss is Geetha Raghunathan of Bloomberg Intelligence. Geetha, let's get to this optimism. What underpins the optimism at the Walt Disney Company that's absent elsewhere?
Yeah, it's really a strong report, John. I mean, the theme parks, I think, is, of course, the biggest contributor of both earnings and free cash flow at the company at about 55 to 60%. For them to come out and reiterate operating income growth for the theme parks at 6 to 8%, but more importantly, raise guidance, EPS guidance to 16% growth from a prior high single digits, just speaks to, I think, broad-based strength across all units, of course, most notably at theme parks, as well as a lot of potential upside, I think, at the direct-to-consumer or the streaming unit, where they've projected about $1 billion in operating profit this year, but we think that can potentially go much higher, especially with the launch of the ESPN product a little bit later this year.
Geetha, it's important to point out that Disney shares are still down about 50% from their 2021 peak. So still a far place to go to climb back to the prior glory. What has Bob Iger done to turn at least the outlook around for a company that had been really beaten up over the past few years?
I think what Bob Iger did most notably, Lisa, is to really turn around the content unit. I mean, the content unit, especially the movies, were struggling with just miss after miss after miss. And then last year, you know, after Pixar's, you know, you had the Inside Out 2 come out, then we had kind of this whole revival in the studio. And now it's kind of, I think, really firing on all cylinders. So you have a pretty good lineup for fiscal 2025. But then you get into fiscal 2026, and the setup is absolutely brilliant as far as the studio is concerned. You have Avatar coming out a little bit later this year, and then they have a follow-up with, you know, Avengers, and then you have a Star Wars movie. So the fiscal 2026 setup, again, is very strong. But it's not just, you know, the movie business, right? It's across everything. It's across streaming, them cutting costs really, really dramatically. I mean, this was a unit that was losing about $4 billion just a few years ago, and they've really slashed their content budget very, very dramatically, I would say, Lisa. It was about $33 billion in fiscal 22. They're bringing that down to $23 billion this year. Again, being very disciplined when it comes to costs across the entire enterprise. I mean, whether that's sports rights costs, whether, again, that's content costs, whether that's marketing costs. So it's really many, many different things that Bob Iger has done across the board, and we're really kind of seeing that bear fruit. Execution, of course, at the fore, very strong execution.
Well, how do they digest this potential 100% tariff cost on movies produced overseas?
Yeah, so if you kind of think about the movie business, again, this is a very, very diversified media company. Yes, they are probably one of the biggest studios in the world. I mean, just a few years ago, they racked up something like $11 billion at the global box office. And again, you know, movies are kind of the starting point for everything at Disney. But if you just kind of look at movies itself in the context of the entire company, they're about content sales and licensing makes up about 8 to 9% of total revenue. And if you look at just the theatrical business alone, it's much lower. It's about 5%. So I don't think it necessarily will have a huge impact. And again, we're really unclear at this point, Lisa, about what exactly this 100% tariff is going to be, whether it's just going to be on theatrical movies, whether it's going to be on streaming movies, whether it's going to be on TV production. So a little bit unclear, but I think Disney has still a lot of different levers that they can pull, and it shouldn't be as onerous as it kind of seems at first glance.
Geetha, the strength in theme parks is just amazing to me. When we've seen all this weakness elsewhere in travel, particularly the airlines, where's that coming from? Where does that confidence come from for this company?
Yeah, so they've been talking about seeing, you know, a pretty nice rebound in domestic park attendance. And even though during this quarter, during fiscal second quarter, we did see some weakness in the international parks, especially in China, I think they can more than offset that with domestic pricing. But more importantly, John, with really this huge investment that they're making in parks across, you know, all their properties, they're adding more rides, they're increasing attractions. But most importantly, they're really investing very heavily in their cruise ships. And so we're seeing them. They actually just launched their 6th cruise ship late last year. They're going to be adding 2 more cruise ships in 2025. But basically, as you just kind of look out a few years, we're going to see them basically double their capacity, their cruise ship capacity. And that's going to get them to, I think, almost you know, $9 to $10 billion just in revenue, just from cruise ships alone. So we're seeing them kind of really, you know, add new rides, add new attractions, and that should keep the demand fairly strong, even though we do have a huge competitor coming up just in a few weeks with Comcast's new Epic Universal. So the fact that they're reiterating guidance just tells us about how much confidence they have in the outlook for that business.
Can you imagine a Disney cruise?
I'm looking
it up.
Make that happen,
Lisa?
Sure. So a 3-night Disney cruise
How
from
much?
New York typically costs around $3,000 to $4,500 for a family of 4, and it includes enchanting entertainment, spacious staterooms, and Disney's private island. Relax in paradise with beach chairs, umbrellas, water slides, and a barbecue lunch.
I would pay to watch John go on a Disney cruise.
That word relax is doing a lot of heavy lifting there.
Listen,
I don't know how much relaxing would be going on.
Listen, if you have
I'd be stressed.
a 2-year-old and a 5-year-old and they get sort of taken care of and they're happy playing in some sort of little waterfall and you could sit there with a drink, I mean, I think a lot of people would embrace that.
I don't drink, but I need a lot of drinks to make that work.
I think I can totally see you on this. Enchanting entertainment.
Geetha, I just want to finish on movies. Snow White bombed. And I just wonder where the good movies are coming from for this company.
Yeah, that was unfortunately a little bit of a misstep, but we do have a pretty good lineup. So, you know, Thunderbolts just opened this past weekend, had a fairly decent opening, and then you just kind of look out a few months, John, and it looks pretty strong. I mean, you have Fantastic Four. Then you get a little bit later into this year, and then you have really, it's an embarrassment of riches, right? You have Zootopia 2, and then as I said, you have Avatar, and then get into the next year, and it's just going to be absolutely spectacular with both Avengers and, you know, the Mandalorian and Grogu movies. So they have a ton of that, you know, things coming up, very, very strong content pipeline for the Disney studio.
We'll certainly take an embarrassment of riches over an embarrassment. Geetha, thank you. Geetha Raghunathan there of Bloomberg Intelligence. Sorry for the hard turn. Didn't work out, did it?
That is quite something. All I can say is...
I apologize.
Okay.
All right.
I love Zootopia. I really
I know you like that movie, yeah. I wasn't referring to that. I was referring to Snow White.
Oh, I'm perfectly aware of what you were referring to. And it's true that, you know, it's better to have an embarrassment of riches than just an embarrassment.
Stock's doing better.
Have you actually watched it even?
Look, I didn't sleep last night. Disney's up by 6%. I'll be in a better mood for the Federal Reserve decision later this afternoon.
I can't wait
Let's
for
get
that.
you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. The UK and US are said to be in intense talks over an agreement that would reduce some tariffs. Securing a deal with President Trump has become a priority for UK Premier Keir Starmer as he seeks to protect British industry from the impact of US tariffs, particularly 25% levies on steel and car imports. Meanwhile, a check on Uber shares, those are falling nearly 5% in the pre-market after the company reported gross bookings for the first quarter that missed estimates. The company's U.S. rideshare business was affected by factors including the LA fires, extreme winter weather, rising insurance costs, and worsening consumer confidence. And Catholic cardinals from around the world are gathered at the Sistine Chapel for a conclave to choose a new pope. The 133 cardinals will have no contact with the outside world during the process and will not be allowed to leave until they reach an agreement. Recent elections for Pope Francis and Pope Benedict were resolved within a few days. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara in the next hour. Up next on the program, President Trump versus Chair Powell.
This is a perfect time to lower interest rates.
It's not clear at this time what the appropriate path for monetary policy will be.
We'll get into that tension next. We'll catch up with the former Kansas City Fed President, Thomas Honig, from New York. This is Bloomberg.
In case you missed it, on Bloomberg Open Interest, how much would it cost to bring production here, Rebecca? I mean, what kind of upcharge would you be looking at?
There is no handbag infrastructure in America anymore besides a couple of small factories in New York City. So not only would we have to build a factory that could make the amount of units we're trying to make, but we'd have to bring back hardware manufacturing, bring back tanning and leather. I mean, these are all things that are purchased overseas and assembled. You know, if you want this to really work, give us grants to build factories, give us several years of tariff breaks in order to make these things happen, and then we'd love to make in America. It just right now, if I were to switch everything to America, my price would double, and my consumer is not here for that. As small businesses doing under $50 million, keep us alive. We are employing millions of people collectively and affecting livelihoods across the U.S.
Don't miss Open Interest live weekdays.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Talks about talks scheduled for this weekend in Switzerland between the United States and China, helping to lift this equity market. Positive this morning by 0.6% on the S&P, on the Russell, higher by 0.8. Under surveillance this morning, President Trump versus Chairman Powell.
We're focused on separating the signal from the noise as the outlook evolves.
Just a perfect time to lower interest rates.
It's not clear at this time what the appropriate path for monetary policy will be.
He's making a mistake by not lowering interest rates. He's keeping rates too high.
It's the latest this morning. The president pushing for lower rates as Fed Chair Jay Powell is set to keep policy unchanged. The former Kansas City Fed President Thomas Hoenig writing, the Fed almost certainly must leave rates unchanged. A stagflation outcome would be the most likely path. Thomas joins us now for more. Thomas, welcome back to the program, sir. Why do you believe that is the most likely path? Why do you believe the most likely path is stagflation?
I think, number one, the economy, while not doing great, is still stable. It was not bad in the first quarter. The imports brought it down a little bit, number one. Number two, I would say that the inflation shock from the tariffs is not clear, as Powell said, so you don't want to get too much ahead of that. I would also point out that there's also a reconciliation bill in the Congress that projects that we will have a higher deficit. We will have some decreases, not only continuation of tax cut, but decreases in some taxes that will be stimulative. And so how do they anticipate that? They have to wait and see to some extent. So I don't think they're in a position to be raising rates, and they know it. And I would tell you finally, inflation is still well above target. And real rates, if you take the nominal rate of 4.25 and the inflation rate of 3, you have real rates of about 1.5%. That's not particularly tight. So those are all factors that have to be entering the discussion today. And the discussion today is about the future, I suspect, within the FOMC.
Thomas, I've got to be honest, most people who've come on the show today have not seemed particularly enthusiastic about this Fed meeting and are probably going to be listening while also reading all of the reports that they have to read for the following day. Do you think that anything is going to come out of today's press conference with Fed Chair Jay Powell, given the fact that he's waiting for the evolving data as there are talks and discussions about potential bills? I mean, it just seems like there is no incentive to say anything.
I think that's correct. I mean, why would he? He knows he can't change, or he shouldn't change rates lower. That's where the pressure is. He certainly won't raise them. He's going to be very coy because he does know we have inflationary impact. There's negotiations starting with China right now on whether or not those tariffs will stay higher or be brought down. That isn't clear yet. And we have a reconciliation bill that he can't figure out yet. So why would he say anything? He's not in a position to, since there's so much up in the air and so much uncertainty. He can't do anything but make it worse by speaking too much.
There is a belief in markets, though, that the Fed will probably be late and that there will then be pretty significant rate cuts at the end of the year, which is the reason why you've got about 3 rate cuts being baked into the market for the remainder of 2025. Do you think this is correct, or do you think that people are underestimating the Fed's resolve to get inflation back down to 2% in something of a more normal time frame, not necessarily the next decade?
Well, I think they're pretty set on getting inflation down. They're very familiar. They've studied it. They've talked about it about the 70s, where they similar situations. Should they lower rates? Inflation has come down somewhat. We see some pressure, and they lowered rate prematurely, and eventually got inflation up to where it was almost out of control. And they don't want to repeat that mistake, so they're going to be very cautious. I'm not sure. Unless the economy really slows in the second half, probably the fourth quarter, significantly, or they see signs that it will, I think they'll wait on any rate cuts this year as long as they can.
So that's going to obviously irk the President of the United States, but he was recently asked about what he meant when he talked about termination. Would he replace Jay Powell? And he said, no, why would I do that? I get to replace this person in a short time, basically this time next year. Do you have any concern about Fed independence right now with this Trump administration?
Well, certainly, the independence is always an issue with the Fed. I mean, this is not new to Trump. I mean, Johnson did it. Certainly Nixon did it. So there's always that issue. I do think that who succeeds Powell will be extremely important, because there will be pressure on the confirmation process, or I should say the nomination process, for that individual to be very, shall we say, available to Trump, to hear his views on why they should cut rates, and primarily always be to cut rates. And I think that will be an extremely important choice that the markets will follow. And that will be the only, I think, discipline on how Trump selects the next chair of the Fed.
Thomas, as you know, as an expert of economic history and Federal Reserve history as well, history's littered with examples of tension between the Federal Reserve and the president. I just wonder, from your perspective, whether you believe this is somewhat different and what would make it unique for you.
Well, I think it's more intense. I think it's different in that sense, if you can reasonably say that. But Trump is in his face about lowering rates rather than behind the scenes where you usually see this happen. That makes it more public, and it puts, I think, the Fed and the chairman in a very bad position, because now, even if they thought, well, maybe we should lower rates this next meeting, they have to be more careful about how that's going to be perceived and how they build the case for that. So it's put more pressure on the Fed, actually, to stay, shall we say, appearing to stay independent, not only being independent. And that is, I think, a tough position to be in for Powell and the FOMC.
It certainly muddies the optics, that's for sure. Thank you, sir. Thomas Honig there, the former Kansas City Fed president. I'm sure that one other thing that might frustrate this president, if we get a deceleration in economic growth, can this Federal Reserve respond to it? If you go back to the update from the SEP, they put out these forecasts every quarter. The one thing that stood out for a lot of us around this table was the fact that they downgraded their assessment for growth for 25, but didn't increase the outlook for cuts implied by the median dot. And I took that away as quite a hawkish move from this Federal Reserve, just a signal that it might be constrained by upside risk to inflation further down the road.
Constrained by stagflation, constrained by the fact that inflation is going to ultimately tie their hands, which is what Thomas Honig was talking about. They are constrained by their remembrance of 1970s and their desire to avoid inflation getting away from them.
Coming up on the program, the conversation continues. We'll catch up with Keith Lerner of Truist, Mandeep Singh of Bloomberg Intelligence, Tom Porcelli of PGIM, and Vishal Kanduja of Morgan Stanley. As this market gets a little bit hopeful about talks this weekend between the United States and China. Talks about talks, Bramo, with the objective being negotiations and hopefully lower tariffs.
Doesn't it sound like fun? We're going to get to talk about talks about talks. We're going to talk about the evolving data as there are talks about talks that the Fed is going to be watching that nobody else is going to be watching, because right now people are not that interested. It's fascinating.
Welcome to 2025.
It's going to be so much fun.
The third hour of Bloomberg Surveillance, up next.
We'll have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board.
I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
In case you missed it on the close.
I think our sports fund is very exciting. We've invested in a number of new leagues that are doing exceptionally well. A number of the investments we've made, we've already seen prices that have gone up already about 50% plus. So what you find in new leagues and new teams is if you're right, it's going to grow exponentially, right? So the whole key and the nice thing about that is you see the ratings the next day. So I can tell you if it's grown, like we've invested in PBR and professional bull riding. That league is growing 30% plus a year.
There's professional bull riding?
Yes, do you want to get on a bull? You'll end up. If you could stay 8 seconds.
I know, this sounds awesome. Do I have to go I don't have to go to rodeo for that. That's
No, you could do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime you want to go.
Okay.
Come, you'll love it. Yeah, we'll chat offline.
Don't miss the close, live every weekday.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
This is a Fed that could be on hold for a long time.
The economy is running okay right now. They don't want to get ahead of this.
Powell's going to be very hawkish.
The Fed's in a tough place. I'm expecting to hear not a whole lot.
The Fed's hands are tied to deliver the kinds of cuts that we've seen in prior cutting cycles.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now. Your opening bell is 90 minutes away, and your scores look like this on the S&P 500. Equity futures at the moment bouncing back from 2 days of losses. We're up across the board on the S&P, on the Nasdaq, on the Russell this morning. On the S&P 500, higher by 0.6%. Going into a Federal Reserve meeting later on this afternoon, a Chairman Powell news conference that not many people are paying attention to at the moment, so look out for that. Earlier on, a few hours earlier, you'll hear from the Treasury Secretary, Scott Bessent, on Capitol Hill. That seems to be the main focus going into the weekend as we schedule talks between the U.S. and China.
We are trying to figure out whether we are in a regime change when it comes to trade and how much that will have ramifications for the underlying economy, which the Fed has to respond to. What strikes me about this moment is that the market is used to responding immediately to fast-moving information. And right now, we are in a slow-moving barge, literally, that is or is not coming over from China that could have dramatic ramifications for the overall economy. We are in wait-and-see mode at a time when a lot of people know big changes are coming down the pipe.
Well, definitely is wait-and-see mode, because the Treasury Secretary said this is about de-escalation. It's not about a deal. It's the very beginning, baby steps starts to potentially a bigger deal with China. What he says at 10 a.m. I think is going to be so interesting, because yesterday, when he was asked about China, he said no negotiations are going on. And then late at night, we got word, the Treasury Secretary put out a statement that actually is going to Switzerland for trade talks. And by the way, the Chinese were also passing through Europe. They're also going to be in Geneva, so we decided we're going to have 2 or 3 days of talks. What he says on Capitol Hill is going to be very interesting, because potentially we'll get a sense if they're willing to at least, at the minimum, bring down the 145% tariff rate to something, say, like 50, 60%.
Just to build on that, he's not going to negotiate in public at all. He pushed back against doing that just last night. But you can read between the lines. When he says things like, it's unsustainable, when the Chinese side says things like, we're not going to negotiate until you bring the tariffs down, I think that tells you that to really get these talks going at a higher level from here between the leaders, the tariffs need to come down.
It needs to be more than just talks about talks. It needs to actually be action. The question is, what are the nodes of negotiation? We know some of them in terms of what the U.S. has been asking for from China. We don't have a sense of just how much absolute bifurcation there is going to be between tech in the U.S. and tech in China, and that is going to be a main discussion point over the weekend.
Stocks are doing better this morning. We're positive by 0.6% on the S&P 500. Coming up on this program, Keith Lerner of Truist on why he isn't rushing into stocks, Tom Porcelli of PGIM on a wide range of outcomes for the U.S. economy, and Vishal Kandudra of Morgan Stanley counting down to the Fed decision. We begin this hour with stocks bouncing back from a 2-day slide on the U.S. and China trade talks as they're scheduled for this weekend. Keith Lerner of Truist is pushing back, writing, evidence suggests the near-term risk-reward profile is less favourable following the sharp market rebound. Keith joins us now for more. Keith, good morning.
Great to be here.
Just want to frame your year so far, just for the audience, because it's been pretty decent. You downgraded equities something like 5 days after equities topped out, all-time highs in the middle of February. You clearly think things have shifted again. The risk-reward profile has changed, given the aggressive rally we've seen off the lows. Where are you now?
That's right. Well, we are thinking that the risk-reward is somewhat less favorable. At the lows, we were down 19%. We were telling our investors to start thinking about upside risk, not just downside risk, because at that point, you were down 19%. You were pricing in a recession, largely pricing in a recession. At this point, as you snap back, we've kind of really priced in a good scenario going forward. So if I look at it, using this weight of the evidence approach, we still think the economy continues to slow down somewhat. Earning estimates likely have some downside. At the same time, when you look at the forward multiple for the market, you're around 20.5. At the peak, we were at 22. I would argue that given the uncertainty, that we shouldn't be back at 22. And it's not just the tariffs. Don't forget, earlier this year when we were at the highs, we had DeepSeek come in. So on the margin, tech valuations should be somewhat lower than they were as well. So putting that all together, it doesn't mean we have to collapse. It doesn't mean we don't have some headlines to keep this market up. But we think the upside is likely capped around 5,800 on the upside. Maybe you squeeze because sentiment is still relatively negative. That's the biggest asset for the market right now.
There's information in the headline. There's information in how the market responds to the headline. Yeah. What do you make of these moves this morning in response to the scheduled talks this weekend?
You know, as we were talking a little bit earlier, I think a month ago, this would have really moved the market much more. I think, we've moved up a lot. So some of this is priced in. The market is pricing in that we're going to get some tariff relief. But the question that I think we're all wrestling with is how much damage has been done. And we still think, look at U.S. GDP estimates. They would come into the year above 2%. They're at 1.3, 1.4. And then globally, you're seeing GDP estimates come down for China, for Europe, for the UK. So it's not just a U.S. story. So I guess the challenge I have is that at this valuation levels, even if forward estimates stay somewhat resilient, you saw that with Disney this morning, you're still trading at a pretty hefty multiple, and we still think there's some downside. Trying to keep an open mind what could go right, and the tech side is something where we've seen spending still pretty healthy, so that's a good story. But at this point, on a shorter-term basis, we just think the risk-reward is a little bit less favorable.
Keith, President Trump's Maximus approach on April 2nd, this Liberation Day, that chart that came out, then continue ratcheting up on China, 145%. Did he cushion the market to then be able to absorb whatever rate he ends on, whether or not it's 10% tariff ring and 60% on China?
I think so. I mean, if you think about where we are right now, we're 15% above that low from early April. So we have a big cushion to get back down there as well. So I do think, listen, you come out with the most aggressive stance, you pull it back. But again, the market at this point, when you've come back and where valuations are, I would say that the market is certainly expecting some tariff relief, but are we not going to see some slowdown? Businesses still are somewhat frozen. And I guess the other thing we've been wrestling with too is there is a difference between the economy and the stock market, right? I mean, the economy, small and middle-sized businesses that we talk to are more concerned. The bigger companies are able to manage this somewhat better, and we all know that the S&P 500 is much more of a growth index with 40% plus in tech and communications. So there's this offset. That's why I also think that low is a pretty good low, because the technology earnings, unlike the overall market, are still moving higher at this point. So,
well, so where are you seeing opportunity then? If you are, sounds like tech companies, yes. It sounds like Russell 2000, no. It sounds like there's a real question, though, about bonds as an offset, about gold. It seems like structurally we have changed the assumptions since April 2nd for at least some portfolio managers.
Yeah, early in the year, back in February, we did downgrade small caps, so we're less favorable for some of the things I mentioned. They are cheap, maybe a bit oversold. From a sector standpoint, because of the back and forth and the whiplash, what we're trying to do is we have a mixed sector approach. So we have our favorite technology or growth play is communication services. You're seeing that with, you know, not only like the Metas and the Googles of the world, but also as we saw with Disney and Netflix. So there's some kind of secular growth there. Our favorite defensive area is utilities, but there's also a secular story there with AI, which we're seeing actually the last couple of days. And on the cyclical side, we're favorable on financials. And our view is like, instead of trying to move back and forth each day with these moves, have your favorite area of defensive growth and cyclical as well.
You said that your ceiling was about 5,800. What's your floor?
You know, well, I think the floor is likely that low, that 48.35, and maybe we find support before that. Maybe 5,100, somewhere in that neighborhood. And again, keep an open mind. I think that floor is good as long as you don't go into recession. Our house view is we're around 50-50, which is, that's where we're basically at. And you did have, the VIX spike and the sentiment that you normally see at bottoms. And the question is, do you just V-shape right to new all-time highs or come back down? And we do think the Fed is somewhat constrained.
This is the big issue we've all got as investors right now. Can the promise of deals continue sustaining this equity market? And is there a risk that between now and whatever the deal looks like, we hit an air pocket in the economic data? And if we do we have a good understanding of what is defensive in this equity market? Can you help us answer all that?
Yeah, sure. I have all the answers for us today. I think the biggest thing as I'm thinking about, again, I always think about, because we're a bit more defensive, what could go right as well. Is the market going to look through this as a short-term hit, right? If we're buying in companies, we're really buying them for the next 5 and 10 years, and that secular story of AI is still there. So I guess the question is, will the market see through some short-term pain, or at least a reduction in growth? Listen, the market is a discounted mechanism, but at the same time, almost have to see it to believe it. So I actually think that will constrain the upside. And listen, if we come back down and we think that we're past this, we'll likely look to maybe upgrade stocks again, but we're just not there based on the risk reward at this point. By the way, I'm not waiting for clarity. I'm not waiting because everyone says, hey, we want clarity. By the time clarity comes, the market has moved. But I'm looking for a better risk reward. And from an asset allocation standpoint, we're not saying to go like 30% cash. We have a little bit more cash. We have a little bit less equities. We still have high quality bonds, which actually have been acting well. We upgraded investment grade bonds on the spread widening recently. We've been bullish gold all year, though I will say short term it's a bit extended as well.
We've seen an aggressive rally off the low. That's the number one question for me, Lisa. Can we keep this equity market grinding higher? Can it be sustained just by the promise of deals? And can it be sustained by the promise of deals even if you bump into some weak, hard data?
A lot of people say that's the ultimate check, hard data. And when it actually does roll over, that is going to be what ultimately could check this sense that we've seen in the markets. I'm wondering about foreign demand and how much that changes in the meantime, how much there's been a structural shift for dollar-denominated assets that coincides with potential hard data that does roll over.
Keith, let's finish on that. Priya Misra talked about this earlier on. We keep going back to this framework. Are we seeing a cycle-level shock or a system-level shock? And if you're still trying to figure that out, do investors abroad behave as if we are seeing a system-level shock and begin to diversify away from dollar-denominated assets? Is there a risk of that playing out? Do you see signs of it already playing out?
On the margin, but I don't think there's a wholesale change. I think there was kind of this abrupt change initially, but the way we're thinking about it from a portfolio standpoint, we've been Team USA for several years, and we still have a slight U.S. tilt, but it's like an accordion. You have more different, you have different scenarios happening. You have the currency moving a lot. We're bringing our bets in. We've been doing that since last fall. We added to EM a little bit. We added to developed markets this year. I mean, it is notable that on this V-shaped recovery, while the U.S. market's still below the highs, Europe's back to all-time highs. European financials are all-time highs. The other thing that's interesting, if you look at the returns, for international developed, they're up about 12%. almost like 9% is the currency on that side as well. Longer term though, we still say, where's the best companies in the world? They're still in the U.S. So we have that battle, but I guess the bottom line is stay with the U.S., but bring in those bets. And I do think there is some signal in that the recovery has happened quicker overseas.
It's still exceptional. What did Mark Rowan say over at Apollo? It's just not hyper-exceptional anymore.
It's heading down to just exceptional. And yet, what does just exceptional look like after so many decades of the U.S. being exceptional when it comes to the currency, when it comes to its funding markets, and then, of course, when it comes to tech development?
A lot has changed since the Fed last met on March 19th. One of the bigger changes in foreign exchange. Euro-dollar was trading at 109 this morning, 113.61. Keith, it's good to see you, sir. Thank you.
Thank you.
Keith Lerner there of Truist with an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. Disney shares are rising more than 7% in the pre-market after reporting fiscal second quarter results that topped estimates. Disney is benefiting from faster than expected growth at its theme parks and streaming business, which led it to raise its full year outlook. Disney also just announcing it will launch its first Middle East theme park in Abu Dhabi. Meanwhile, Treasury Secretary Scott Bessent and Trade Representative Jameson Greer will hold talks with China's Vice Premier He Lifeng this weekend in Switzerland. These will be the first confirmed talks between the two countries since President Trump announced tariffs of up to 145% on Chinese imports. And Tesla's China-made shipments dropped again for the 7th consecutive month. The EV maker shipped just over 58,000 Model 3 and Model Y vehicles from its Shanghai factory last month. That's a 6% decline year over year. In China, Tesla faces strong domestic rivals such as BYD. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. More from Yahara later this hour. Up next on the programme, the Morning Calls. Plus, Mandeep Singh of Bloomberg Intelligence as trade barriers weigh on chip makers. From New York, this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
So the opening pair is about 1 hour and 14 minutes away. Equity futures at the moment firmer by just 1/3 of 1% now on the S&P. And I just want to sit on that just for a moment. As we said just moments ago, you can learn something from the headline and how the market responds to the headline. And Keith Lerner of Truist making the point here, Lisa, that maybe there's something to be said about this market only running a third of 1% in the face of something we were all hoping for over the last several weeks.
This is a market that is realistic about what can get accomplished and has been trying to price in how companies can adapt and adjust at a time when there definitely are going to be higher tariffs. The fact that there is any rally gives you a sense that the worst case scenario has been taken off the table. It doesn't speak to necessarily what this market's pricing in.
Also, it was weeks ago when the Treasury Secretary told me in Argentina that these rates were unsustainable. So it felt like the market's already starting to price in the fact that the rate on China, that 145%, is bound to come down. We've heard that from a number of officials from the White House. Now we're going to have talks of it. So the market is taking this in stride. It's optimistic, but they know that this is not the grand bargain and the full deal.
Can the promise of deal keep sustaining this equity market rally? Can it? Right now, you've got an answer. We're up a third of 1%. You'll get more answers in the days ahead. I think this market now wants some evidence of actual deals, a change to policy. Let's get you some morning calls. That's the price action. First up, Barclays, raising its price target on Marriott to 252, saying its luxury and group mix is resilient in today's backdrop. Your second call from UBS, raising its price target on Rivian to $13, saying there is a, quote, air pocket for the stock until its new car launch next year. That stock is down by 1%. And finally, Bank of America upgrading AMD to buy, seeing potential for it to deliver 20% or more top-line growth this year and next. That stock is up by 1.2% this morning. Let's stick with AMD, the chip maker, saying U.S. restrictions on sales to China will cost it $1.5 billion in revenue, despite an otherwise upbeat outlook. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, good morning.
Morning.
They're putting a price on it. Have others too?
Well, I mean, 1.5 billion, when I look at, the overall estimates, it's down 3% from what they would have done otherwise. So to me, second quarter guide, 700 million write down because of the China impact. It tells you that the numbers, at least the top line and the bottom line, aren't going up. There is an impact. And look, AMD executed well, but the numbers were going up until now. So that is what has changed in terms of this market is AI is still that secular trend, but you're not seeing the lift that you got from, better execution and AI before. And that's where I think companies will struggle, whether it's NVIDIA or AMD. And
two separate things to think about here, tariffs and ultimately restrictions.
Yeah.
We're focused on tariffs. Management teams outside of this industry assume that tariffs can be negotiated. Do management teams in this industry assume that restrictions can be negotiated, or they believe they are the new rules of the game, the new laws of the land?
Well, so Lisa Su last night said the total addressable market is not changing. It's still 500 billion, and they think even if they're not able to sell in China, they'll be able to make up somewhere else. Now, my question is really, what surprised this market was you had training, inferencing when it comes to AI, and all these models keep getting released, which is good for compute requirements. It's just that if China is able to manage DeepSeek and their models without using any of the chips from NVIDIA, AMD, or any of the chip makers here, it tells you that the moat isn't as strong as everyone believes it to be. You can do it on Huawei chips. They are able to make chips that serve as an alternative. And that's where I think there is some figuring out to be done when it comes to, how much is this demand sustainable? How much of growth rates can sustain in 2026 and 2027? Right now, those comps look very tough when I look at, the companies have confirmed their CapEx numbers for this year. Everyone has said they will spend, in aggregate $350 billion across the 5 hyperscalers. So that's good. But the growth rate next year, nobody knows.
Mandeep, though, how credible is that they were able to do this without access to U.S. high-tech chips?
Well, I think it is credible. Imagine how else are they training the models? The models have been open source. They are being used to develop AI agents. And even if there was a pull forward in demand and, they got NVIDIA GPUs and AMD chips and piled them, but look, they are constantly serving the models. These models are being used for inferencing and AI agents and production use cases. So to my mind, this is not a one and done thing. This is continuous. And that's where the demand is more sustainable. It's just they're able to overcome the supply hurdles that they had before.
Jensen Huang spoke about in Washington, D.C., how China is really very close to where the United States is. This race, are they still even behind us?
Well, so, I mean, when I compare them to OpenAI's O3 model, what they just released, it's great. I mean, if you play around with Gemini and OpenAI's latest models, they may not have the latest multimodal functionality that everyone is looking for in these models because they keep improving every 3 months. But at the same time, when it comes to text-based chatbots, their models are equally good. That's why DeepSeek had such a huge adoption when it was released. So clearly, they are making progress. They're not at the cutting edge as the OpenAI and Gemini models are.
I'm really struggling to keep up with the narrative shifts because on one hand, you've got the US versus China and technology. On the other hand, you've got tariffs and restrictions. And then on the other hand, you have what we were talking about 6 months ago, which is the AI adoption that was going to be insatiable and where there wasn't enough supply to meet the demand and investment was going through the roof. What happened to that part of the equation, overwhelming the other two?
Well, so I think there was a shift post DeepSeek. That was the big moment this year where everyone was so fixated on training, you know, how big the next version of the model is going to be. Now it's the inferencing piece, which is really using the models in a different way. You're applying more reasoning capabilities. And with reasoning, you don't need to build, 1 million GPU clusters. You can do away with smaller clusters and use the inferencing, which is what OpenAI is doing. So that shift, along with the fact that they can't sell to China, and now the cost base is changing, because what if AMD has to make their chips here in the US? The cost base changes, the margin profile changes, so I can't see any margin upside for these companies, given the hand they have to deal with right now, with all these 3 variables that I just mentioned.
That's not a great assessment. Have you been following CrowdStrike this morning? I'd love your thoughts on this. If you're just joining us, so they're cutting positions, and they've said this to their staff today. Offices will be closed May 7th, May 8th. Please plan to work from home. If you are already in the office, I encourage you to head home for the rest of the day. What do you make of this communication from the company?
I mean, it is a surprise that they are asking everyone to stay home, but it's not a surprise that, every company is looking at how efficient they can be in terms of just, the operational side. And look, the AI wave is impacting how these companies are changing their workflows, whether it's a tech company like CrowdStrike. So we'll learn about more details, but clearly it is sending a signal.
So you believe, and I think this is an important distinction, you believe this is an efficiency drive driven by technology and not necessarily by a weaker demand backdrop?
A little bit of both. I can't say, because look, even with chips, we know there was a pull forward in demand. There has been a pull. Apple didn't acknowledge there was a pull forward in demand, but look, everywhere you look at, there was this risk of tariffs impacting, driving up the prices. So I do feel there has been a pull forward in demand, but clearly there is that efficiency side, which we'll learn more from all the tech companies. I'm just surprised that it's coming from a cybersecurity company out of, all the areas.
Where were you expecting it from?
Well, the larger the company is, like a consulting company, IBM or Accenture, if these companies would say, oh, we are getting different types of projects, so that's where we are going to hire that kind of talent first. So that's where I was expecting, depending on the size of your employee base.
We've said it now for a number of years, Lisa. We've been waiting for that headline to drop from one particular industry, not just tech, but also from finance too. At what point do you start to see these cuts, larger cuts, and not because of the demand backdrop, just because of this improved technological efficiency? You hear talk of it. We've yet to see big cuts in the way that maybe we're going to start talking about.
Well, we can say, hey, Siri, book my meeting. Hey, Siri, by the way, find a good restaurant for me. Hey, Siri, tell me where I should entertain my client. And hey, Siri, can you potentially end up coming up with some sort of proposal for me to give to my client this afternoon? And my phone is going absolutely bonkers as I speak.
Oh, do you use Siri?
I don't use Siri, but it's trying to get me to.
Oh,
and
right.
It's just got that bubble.
Because I was going to say, I mean, if that's how we're all going to operate, that would be great news for Apple, because no one really uses Siri, do they?
But it's just, my phone's just freaking out. It's so excited that it's being engaged. I'm sorry. Actually, you can go back to Siri.
When you're on air, Bramo, don't use Siri, just in case, all right? Mandeep Singh of Bloomberg Intelligence. Mandeep, thank you. Appreciate it. It's good to see you. Several Tories to keep on top of. Got to keep on top of the Federal Reserve as well, regardless of what people are saying about it. Apparently, it's going to be an absolute snooze. So Tom Porcelli of PGIM is going to join us to break it down. And then we'll get some reaction from Vishal Khanduja of Morgan Stanley. As we count you down to that Fed decision, lots of questions about the bond market. Will the bond market be there for you in an economic downturn? Let's make it simple. Will the 10-year Treasury rally if the data heads south? This morning, yields are higher by 2 basis points. The 10-year, 4.32. The 2-year up 3 basis points to 3.81. From New York, this is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
The opening bounce 60 minutes away, and equities are firmer by just 1/3 now on the S&P. The gains are fading. On the Nasdaq, higher by not even 0.2%, even as we schedule these much-anticipated talks between the US and China. Maybe the clue there is much anticipated. We've been waiting for this and rallying on it over the last few weeks. With 60 minutes until that cash open, with your morning movers is Danny Berger. Hey, Danny.
Hey, John. We had Disney reporting earlier in the morning, helping to allay any fears of a consumer slowdown. They increased their guidance for the year and increased the price of their streaming services. As for the quarter, they reported that was also strong. They were able to beat when it comes to things like their theme park attendance. They also announced after their earnings that they'd be opening up a park in Abu Dhabi, licensing the IP. Can only imagine how hot that would be to walk around. Regardless, shares are higher by 8.6%. Now, we also heard from Uber this morning, an opposite story and concerns here about the consumer. That's even though they increased their guidance, is because the quarter that they reported was weaker than expected. And there's this fear that consumers are pulling back on the ride-sharing app because of the economic environment. Now, they said it was because of a stronger dollar, but even at a constant currency, it was weaker than expected. So shares down 3.6%. Finally, wrapping things up with CrowdStrike. They already had earnings about 2 months ago. Those were also weaker. Was that software update that caused that glitch across computers and servers everywhere that was weak? Well, they had a release today announcing a new streamlining, changes that they were going to make at the organization. They're going to let go about 5% of their workforce. That's about 500 people. Shares falling 4 1/3%. And just an update on this, I mentioned in the last hour that they're closed today and tomorrow for their offices. It does seem that it's going to be tied to the fact that they're letting people go, because they said they're going to start those conversations in the next few days. So if you are one of those few people who are asked to come into the office, it might not be a good thing, John.
Danny, thank you. I thought so with them, that's for sure. Never good to see headlines like that, regardless of the company. The stock is down at the pre-market. The opening bounce about 60 minutes away. The Federal Reserve decision later on this afternoon. Most economists, almost all economists, expecting them to keep rates unchanged despite the pressure coming from the White House. With more, here's Mike McKee. Good morning, Mike.
Good morning, John. I feel a little bit bad talking about this, so I got to start out by saying that the Fed Decides on Bloomberg Television at 1:30 this afternoon with John and Lisa and Tom Keene is going to be riveting TV, must watch. You have to look in, but you're not going to learn much. The Fed isn't going to change interest rates today. Nobody expects that. And we're not going to see any new economic forecasts, and there's no new dot plot. So what is there to look forward to? Pretty much nothing but Jay Powell's news conference, and what are we really going to get from him at this point? What kind of guidance does he want to give? Not much. He'll be saying, we can afford to wait. The economy is in pretty good shape right now, and it's better that we are late to move because of tariffs than we start off by moving in the wrong direction. And then, of course, everybody will ask about the president and his comments about the Fed, et cetera, and I'm sure that Powell will fall back on his, I'm not going to comment on that. So I'm not sure where all this leaves us at 3:45 when the news conference is over and you guys have to wrap it up. I'm sure everybody will be looking at Fed funds futures, but I just did want to point this out. they're kind of useless at this point. There's almost no point in looking. This is July, which is right now kind of where the first move is priced in. Look how volatile that is. Every time there's a new data point and every time the president opens his mouth, those move around. I don't think the White House knows. I don't think the Fed knows. Nobody really knows what's going to happen going forward. And so we all go into this mystery together.
Mike McKee, nobody's got a clue. Appreciate the update. We'll have more from Mike in just a moment. Tom Porcelli of PGIM Fixed Income has this to say. He's got thoughts. What started out as a year that could have been easily achieved trend growth has now quickly deteriorated. We will be lucky to see growth in the 1% range. Tom joins us now for more. Tom, good morning. Good to see you.
Good to see you all. How's everyone?
Very well. Been very busy since we last spoke. A lot has changed since the Fed last met. March 19th, they put out an SEP.
Yep.
And in their SEP, their forecast for growth for this year, for 2025, was 1.7%. And that was a downgrade from the previous forecast. And we all sat around the table and said, well, look, compare that to where the median dot is. They've downgraded their assessment of growth, and the median dot is unchanged. They've not increased the outlook for interest rate cuts. My question to you, if they put an SEP out today, and one is not due, but if they did and had to downgrade that GDP target 1.7% down to, say, 1%, what would the median dot do?
So they would be in good company if they downgraded it to 1%. Yeah, the median dot, I think, would not move. And I think this really sort of drives home where they're leaning, right? I mean, in terms of dual mandate, it's entirely about inflation right now. And, you know, the irony, of course, is I think the administration is sort of, you know, as much as they desperately want the Fed to cut rates, I think all that's happening is actually it's just going to sort of force that day out even further. So we expect cuts this year, but we just don't expect them, you know, immediately. I mean, we don't expect that. I think even July is actually looking a little too early for us. So I think it'll be more backloaded. But I think that there's no question that if you have inflation above target, if you have inflation expectations that are starting the process of becoming unanchored, and if you're now waiting for the inflation thrust from tariffs, I think that this really sort of pushes the Fed to the sidelines.
Can you help us out a little bit? No one knows anything about anything. These Fed officials have actually been going around the country listening to business leaders and talking with people. The whole Fed listens idea.
Yes.
Are they gleaning any more information about the stasis in C-suites, the idea of what companies are doing and how that could trickle into the economy?
Yeah, I mean, honestly, it's littered in the Beige Book, right? I mean, in the Beige Book, you can hear this. In the ISMs, you can hear this. I mean, anything that actually has some sort of like, you know, sort of qualitative sort of assessment attached to it, we hear it loud and clear in all of these reports. Now, I think this gets to a really important idea because Powell keeps on saying, hey, but, you know, the soft data is, you know, sort of softening, but the hard data remains firm. Okay, but at some point, the soft becomes the hard data. And I think we have to sort of recognize that. You know, it's funny, I think the last few years have really done a disservice to this entire conversation because there has been a divergence between the hard and the soft data for reasons that are pretty clear, right? I mean, which I'm happy to elaborate on. So I think if you just lop off the last few years and you look at the hard versus soft data historically speaking, they do move together. So I think it's just a question of time now before it sort of translates.
Neil Dodd has put out there this idea that hard data is getting inflated by the pull forward effect.
100%.
And there's this feeling that you really have to look at the soft data, which is a much more accurate reflection now than, say, a year or 2 years ago.
Yep.
If that's true, why are you less worried about some kind of real pernicious outcome for the economy, given how negative the soft data has looked?
Yeah, so which is why we've taken down our growth expectations. I mean, and not just taken down our growth expectations, but raised our recession probabilities. I mean, it's a coin flip right now, whether or not you have a recession. We still expect economic expansion to continue at a much slower pace. But I think, you know, we are taking that to account, I think, in a very meaningful way, recognizing that the downside risk, I think, is growing seemingly by the day.
Coin flip based on what? What's the catalyst? Whether or not deals, credible deals, get done with trading partners?
I think the window is closing rapidly. I think if you don't start to see some real deals, which again seemingly they're teeing that up right now, I think that the confidence that's already been wrecked, I think, remains that way, and people and companies stay on the sidelines. And I'll say one last thing on this, because I think it's such an important idea that I think everyone's missing. Let's say you do get credible deals. And if you have the threat of tariffs that remain in place even after the deals get done, which I can easily see a scenario like that playing out, then I think that just actually keeps already crumbled confidence pretty suppressed.
This keeps going back to the theory that maybe we've started a process.
Yep.
The process has started and it becomes self-fulfilling. What is on your dashboard beyond just, say, volume going through the port of LA.
Yeah.
What's next? How do the dominoes fall?
Yeah, I think it gets to exactly this idea that we were just talking about. I think the dominoes have to fall, and I think this is the most critical domino. It has to be, okay, tariffs are done, right? Like, we've achieved what we wanted. Because if you keep the stick of tariffs out there, I think that the uncertainty that everyone keeps on talking about will just remain in place.
There's a price for that uncertainty. And right now, that price, Lisa, is wait and see. A lot of companies, to your question, are just sitting there on their hands and saying, got to wait and see.
In the meantime, though, they have to raise prices. So they might wait and see when it comes to their investments. They might wait and see when it comes to hiring people. But some of them, at least, have talked about how they can't wait and see when it comes to at least passing along that price increase, which is the reason why you might see that inflation aspect reflected faster than anything else.
And actually, can I make one last point?
Sure.
I know that's like the cue for you wrapping it up. So I think...
How did you know?
I know your tricks. So I think... Just keep in mind something to this really important idea. If all of a sudden you start to see margin compression, right, profit margin compression, then the labor part of that equation becomes even worse. I mean, look, we're already expecting labor to slow down, and there's already signs that that's happening. That would make it, I think, meaningfully worse.
I have one more question. See, I'm ready to go. Mike McKee says this is going to be really boring. How could you make this interesting, this news conference? What would you ask the chairman?
So I think that this would be one of these events where I'm guessing Powell would love it if there was no press conference attached to this. I don't know that there's anything more that he can say that's new. I think, and in fact, in fairness to him, I think he's doing the right thing. I think he's basically saying we're wait and see mode to see what happens, and I can live with that narrative.
We know each other too well. Go away. Tom Porcelli, feature. Tom, good to see you.
Good to
Thank
see
you,
you,
sir.
guys. Yep.
Let's get back to Mike McKee. Mike, just to sum up that conversation, I think this is really important. There's Tom Porcelli basically telling you that to some extent, this Federal Reserve is constrained even if growth decelerates. That if we had an SEP today and they downgraded the outlook for growth, they wouldn't increase their projection implied by the median dot for interest rate cuts, Mike. And I just wonder if that's something you're hearing a lot of as well.
Yes, and we've heard that from a number of Fed officials because, as I mentioned earlier, they would rather be a little bit late on either inflation or growth than to move early in the wrong direction and have to completely reverse. Suppose inflation goes up and you've cut rates because you thought growth was falling, then you have to go back to where you were, and then you have to go above that again, which only makes things a lot worse for the markets. You can see next week going to be extremely busy, though. We will have this kind of market reaction because we get CPI, PPI, and then retail sales, so we'll get an inflation and growth view next week. And look at CPI, the forecast is we're going to see a rise, whether it's tariff-related or not, and it probably is in terms of the forecasts. We're supposed to see CPI go up again, and that's not going to be particularly good news for people in the markets trying to figure out what the Fed's going to do.
Mike McKee, thank you, sir. Looking forward to Mike's questions in the news conference a little bit later on in Washington, D.C. Jumping in around the table, Vishal Kanduja of Morgan Stanley joins us now for more. Vishal, good morning, sir. It's good to see you.
Great seeing you.
Inflation is the big piece of this story. Do you hear a chairman later on this afternoon that has concluded that the outcome of this policy shift in the last month is weaker growth and stickier inflation?
I think I'll get back to that one as well. In my mind, I think the market is definitely looking for a repeat of that reaction function from the Fed, that they are still focused on more on growth downsides versus inflation upsides here. I think the market is still trying to eke out from the Fed's reaction function. Are they going to look through some of those steamier prints, one of them probably the next week, that is going to come out at a point where growth is not yet showing the deceleration because of the binge that has gone through in the economy? I think the market might be disappointed in that one, given that the Fed is going to be very, very patient. I think they've done the heavy lifting of 100 basis points last year. They can be patient here to see what the data is and then react to it at the back half of the year.
It's how they react and the reaction function that is really important here. So let's build on some of that. They're all saying different things in their speeches. So I'm basing this just on the SEP from last time around. What I see in their reaction function is if inflation does start to creep higher this year, they see it as a one-off and they won't hike. What I also see, though, and this can become more concerning in the months ahead if the data starts to weaken, is that they're basically telling you if growth comes in lower than we expected, we aren't going to rush to cut either. How do those two things stack up?
I think they want to be very, very clear about inflation this time in their minds around the committee table. They've seen how 2022 worked out. Again, completely different dynamics of supply and demand shock at that point. We're seeing the I think the opposite of what is going to happen at this point, given that we are not going to be spending so much from the government. I think we are going to hopefully curtail that, and we have over the last 6 months on that part. We do think that the patients should not be confused with that they don't have enough in the toolkit, and they won't act as fast as they did over the last 2 years when the need was there. I think if you look back in 2022, they were slightly behind the curve. 75 basis points came out. They felt similarly, I think if we had the same meeting, Q3, Q2 of last year, 2 or 3 of those unemployment reports, whether there was noise in the data or they were truly down, came back with 50 basis points, 100 basis points in three meetings very quickly. So I think they feel pretty patient in that, or pretty comfortable in that regard, that they have still quite a bit in the toolkit before the difference between where they are today and where the terminal rate could be if demand destruction shows up in the back half of the year.
That's all predicated on the idea that the United States remains the dominant currency, remains the dominant funding market, that treasuries retain their role as the haven asset and have that sort of counterbalance to any kind of cycle. Do you think that that has changed for the Fed and creates a more challenging backdrop for them to respond to the same way with the same tools?
Absolutely, and I don't think that is just because of April 2nd. That was already happening as we were getting ready for the inauguration day. I think the 4-point agenda from the current administration throughout the election timeframe was tariffs, taxes, immigration, and deregulation. I think the sequencing of that agenda point has been opposite. So yes, the back end is very clearly showing us that it's not about just demand and supply, but about a credible, sustainable deficit reduction plan that we've failed to still show up with the at this point.
But you said earlier you think that they're going to curtail government spending. What gives you that conviction? Because every time the Treasury Secretary talks about reconciliation, it's more tax cuts.
Hopefully, I think the two completely opposite forces here, or opposite things that we are hearing from the tariff plan, one is deficit reduction, and then the other side of it, which is completely opposing to that, is manufacturing renaissance here in the US. We need to get that clarity. Where is the administration guiding us towards? If it is actually deficit reduction from this, then yes, I think we will see some of those dollars being used for the other side of the tax plan, except July 4th is the date there.
So let's get into fixed income. What do you do? Within fixed income, where you're finding diversification, what provides you that ballast in the portfolio if risk starts to gap out, i.e. spread starts to widen? What do you see there? You're dialing up exposure to credit? What are you doing within fixed income right now?
I think we've taken out all our shorts. So we were coming into this, we were at the least amount of credit overweight, almost underweight to investment grade credit at one point in March. So we've taken out some of those. We've started to cover some underweights within credit, within the portfolios, because we are not at 4-decade tights in spreads at that point. Or shorts, in other words, are more expensive at this point because yields and spreads have risen up from that point. But spreads, just to be clear, are not reflective of the demand destruction or the recession that might be in the back of the year or the beginning of 2026. 5-year is a great spot right now.
Why does everyone love the 5-year?
I think it is, you don't have to be specifically correct on when exactly is the Fed going to go. We know demand destruction is coming. We know they have quite a bit in the toolkit. Over the next 18 months, they will be on the double side of monetary policy or monetary policy reaction to that one. 0 to 5-year, or probably that 3 to 5-year, gives you that comfort level that you still have a great carry potential for 4% there. Still that negative correlation. I think we've seen it throughout the month of April. I think the back end is what is concerning. So I think we have, yes, I think we don't have too much of steepeners because it's quite a bit of a consensus trade at this point. Yep. So we're holding off. 83 basis points on 530s is a great point to re-enter. And it's still low hundreds could be the target there.
Vishal, smart as always. Clinic, thank you, sir. Vishal Kanduja there of Morgan Stanley, echoing what we heard from Priya Misra of JP Morgan a number of hours ago. Like the belly of the curve, a little bit more cautious further out along the curve, going to the long bond. Let's give an update on stories beyond fixed income, some of our top stories this morning. With your Bloomberg brief, here's Yahira. Hey, Yahira.
Hi, John. Pakistan says it has shot down 5 Indian planes carrying out strikes inside its territory. India says it ordered the strikes against what it calls terrorist camps after last month's attack in Kashmir that killed 26 people. Pakistan says 8 civilians were killed in the Indian raids and has vowed to respond. Weight Watchers has filed for bankruptcy after struggling to compete with popular weight loss drugs like Ozempic. The company plans to execute a restructuring plan that would cut about $1.15 billion in debt from its balance sheet. It needs approval from a bankruptcy judge before it can move forward. And Catholic cardinals from around the world are gathered at the Sistine Chapel for a conclave to choose a new pope. The 133 cardinals will have no contact with the outside world during the process and will not be allowed to leave until they reach an agreement. Like in recent past elections, the process will likely take days. That's your Bloomberg Brief. John?
Yara, thank you. Thanks for this morning. Appreciate it. Up next on the program, we'll set you up for the day ahead. We'll catch up with Tyler Kendall down in Washington, D.C. as we wait for Treasury Secretary Scott Bessent to head to Capitol Hill. Live from New York, this is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good, but as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episodes this spring, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The opening balance 38 minutes away, and equity futures are firmer by 0.4% on the S&P 500, bouncing back from 2 days of losses on the prospect of talks this weekend between the US and China, which hopefully lead to a reduction in tariffs. Coming up this week, coming up over the next 24 hours, look out for this at 10 a.m. Eastern Time. Day 2 of Treasury Secretary Scott Bessent's testimony on Capitol Hill. At 2 p.m. Eastern Time, a Fed rate decision. 30 minutes after that, a news conference with Chairman Powell. On Thursday, another round of jobless claims and a Bank of England rate decision. And this weekend, there it is, US-China trade talks in Switzerland. Joining us now for more, Bloomberg's Tyler Kendall joins us from the nation's capital. Tyler, 10 a.m. Eastern Time, the Treasury Secretary, Scott Bessent, might get more of a grilling, and this time we've got something to really get our hands around. Talks between the U.S. and China.
Yeah, no doubt, John, that these lawmakers are going to have some fresh questions when it comes to tariffs amid this development that they are jump-starting talks with China this weekend. Now, he's going to be in front of House Financial Services today. It's going to be a full committee hearing. It's going to be much longer than yesterday's. And you had the chance to speak to the chair of that committee, French Hill, yesterday, who told you that the #1 question his constituents have is clarity when it comes to the trade strategy amid heightened concerns about price pressures and empty shelves. I'd expect these lawmakers to ask about the timeline de-escalate. But in recent days, we've really heard the Treasury Secretary push the broader economic agenda here when it comes to tax cuts and reconciliation, telling people to focus on the bigger picture that these lawmakers are so closely intertwined with. But of course, John, that doesn't mean he's not going to face some tough questions on this too, including by members of his own party. There are at least 3 members of the House Freedom Caucus on the committee today. These are those fiscal hawks that are really pushing this White House for deeper spending cuts to offset their tax cut plan, even amid heightened concerns about what that could mean to benefit programs like Medicaid.
Tyler, thank you for the update. Tyler Kendall down in Washington, D.C. More from Tyler later on the day on Bloomberg TV and on Bloomberg Radio. Lisa, this is what market participants want, the bulls at least. They want the conversation to move from trade and move quickly to taxes.
Yeah, although be careful what you wish for, because if you start to get tax cuts that are not offset by potential gains or savings elsewhere, the bond market starts to perk up a little bit, maybe not in the best way.
What I loved today was Priya Misra talking about peak uncertainty. If that was April 2nd, we've been in a plateau since. The uncertainty is going to continue. Whether or not it's trade, whether or not it's taxes, there's going to be uncertainty for the remainder of this year.
Will we get some clarity later this weekend? You've said this repeatedly. The Treasury Secretary has as well, that the situation at the moment between the US and China is unsustainable. The Chinese have said, and we've talked about this all through the morning, the Chinese have basically flagged, they've signaled, we're not going to have serious negotiations about trade until you reduce your tariffs. Is this weekend too soon to expect that to happen?
No, I think that's potentially the one win that could be for both sides out of this weekend, these talks. It's not going to be a deal, but it's going to be de-escalation. So what does de-escalation look like? 145% and 125% come down to something. That has been breadcrumbs from both Beijing and Washington for weeks. So I imagine they can leave Geneva with lower tariff rates.
What is the something? 50, 60, 70? And what is the destination?
And is it sustainable? What every single executive has said is we just want something consistent we can work with. Do you get a sense that what it comes down to is the consistent new normalcy, or is that just a placeholder number as talks continue? And that is a difficult aspect.
What's normal these days? Struggling to work that out, that's for sure.
Amen to that.
Don't know what normal is anymore. We're counting you down to the opening bell. It's 35 minutes away. Open interest picks up in just a moment. Equity futures at the moment positive by 0.4%. Coming up at 1:30 Eastern Time, our coverage begins. A Bloomberg surveillance special. The Fed decides. We'll be catching up with Bob Michael of JP Morgan Asset Management, Kathy Jones of Charles Schwab, Rich Clarida, the former Fed Vice Chair, now at PIMCO, and Jeff Rosenberg of BlackRock. And then tomorrow morning, Stuart Kaiser of Citi, Kelsey Barrow of JP Morgan, Nouriel Roubini of NYU Stern, and the former Kansas City Fed President Esther George. Hope to see you later on this afternoon. Understand if you've got better things to do, but if you want to tune in and talk about the Federal Reserve, we'll be here. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Why is Baltimore so important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come. While we've invested in the convention center, the reason we focused on housing and getting rid of the vacant housing, the reason we focused on violent crime. And now Baltimore is having among the most precipitous drop of anywhere in the country when it comes to homicide. homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
The incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why, but we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
All right, we have positive markets, 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Shinoy Bassick is at the Milken Conference in Beverly Hills, and Bloomberg Open Interest starts right now.
It is showtime for Jerome Powell, and Donald Trump is watching. The Fed expected to keep rates on hold despite the president's pressure to cut. And we have signs of de-escalation. Top officials from Washington and Beijing will meet for trade talks later this week in neutral Switzerland. Plus, earnings season is still underway with results from Disney easing fears of a slowdown from the consumer. Katie?
And on that note, let's take a look at Disney shares because they surprised Wall Street with an earnings beat, also raising their 2025 outlook on strong demand for parks and for streaming. You add it all together, shares up 9% right now, Matt Miller. They had been beaten down quite a bit, but still quite a rally.
Yeah, absolutely killing it. On the other hand, Uber bookings missed estimates in the first quarter, citing issues like the Los Angeles wildfires, as well as worsening U.S. consumer confidence and economic uncertainty. Katie, you can see the shares in Uber down 4% in the pre-market.
We're also keeping an eye on the latest tariff developments because Treasury Secretary Scott Bessent and Trade Representative Jameson Greer will enter trade talks with China this weekend in Switzerland. Now, yesterday, Bessent explained how this meeting came together.
I was going to be in Switzerland to negotiate with the Swiss. Turns out the Chinese team is traveling through Europe, and they will be in Switzerland also. So we will meet on Saturday and Sunday. And look, we have shared interest that this isn't sustainable.
Bloomberg's Tyler Kendall joins us now from Capitol Hill. And Tyler, Scott Bessent was careful to set expectations here. He made it clear that these talks will center on de-escalation rather than necessarily getting that big trade deal.
Right, exactly, Katie. De-escalation before they can really talk about any of the contours of a trade deal going forward. And Bloomberg Economics cautions that they don't think there's going to be meaningful tariff relief quickly or easily for that matter. Now, of course, the optimistic scenario here would be they meet this weekend and they agree to lower tariffs on a reciprocal basis. But we know that China, for instance, has called on the U.S. to remove or at least slash significantly levies on a unilateral basis. And while President Trump has said that he's open to lowering tariffs on Chinese imports, saying the current rates amount to essentially a trade embargo. We know this White House would like to see Beijing take the first steps to de-escalate. Perhaps that could mean China pledging to boost U.S. imports, perhaps resurrecting some of those purchase agreements under the Phase 1 trade deal. They could tighten controls when it comes to fentanyl flows. They could loosen restrictions and curbs when it comes to critical minerals, things like that. But it really does remain to be seen exactly what the U.S. is looking for in order to see those talks move forward. And officials tell us that's by design. We keep hearing Treasury Secretary Scott Bessent call this strategic uncertainty. But Katie, to be clear, the other side of this, of course, is that President Trump in recent days has been threatening to just set a rate and walk away from the negotiating table if he's unhappy about how negotiations are going. We did hear from Beijing's Commerce Ministry earlier this morning, who said that they hope that the U.S. can move forward with sincere intentions.
All right, Bloomberg's Tyler Kendall there in the U.S. Capitol. Thanks very much. We'll keep on top of Washington later in the program. We're going to show you Scott Bessent's testimony, but I want to get back right now to earnings on Wall Street. Uber bookings fell short in the first quarter as it sees a slowdown in the ride-sharing business, but second quarter expectations actually beat estimates. Let's discuss with Bloomberg Technologies' Caroline Hyde. So, Caroline, going the other direction of Disney, Uber says consumer weakness is showing through.
Well, actually, there's some resiliency coming from Dara Khosrowshahi, the CEO, who is going to join us a little bit later. But he's saying, look, thus far, we haven't seen a particular impact on the consumer. But yeah, revenue growth had been slowing. And we're seeing overall revenue up about 14%. People have wanted to see perhaps a little bit faster than that sort of a growth. The delivery side of the equation still very strong, but it really seems to be about people getting into cars. How much are they having to pay a little bit extra? Some of the insurance costs that they've been blaming. They are looking at more affordable kind of offers and products. But the second quarter guide was strong. So I think some analysts and investors are saying, look, we're trimming back because this stock is up more than 40% so far this year. It's a massive outperformer. Wow. And perhaps they just didn't live up to the highest expectations for fiscal first quarter when it came to the ride side of the focus, but they've got a lot of levers to pull. They're looking and leaning into the taxi side. They're looking at AVs in particular. Look, we're having driverless cars over in Austin going great guns. They say this is really bearing fruit for them. And interestingly, they've been investing in Chinese companies to bring that to bear even more in Europe, for example.
Great point, too, on just how high the expectations were heading in. Similar in some ways to what we saw with Palantir in terms of the stock outperformance. Looking forward to that interview. But let's also talk about AMD. A lot of eyes on this chip maker. The first quarter was actually pretty good, but a lot of caution going forward.
And again, it's about China. I mean, it's interesting that Uber's doing deals in China. At the moment, AMD, Lisa Su, the headache is the $1.5 billion hit to revenues that they're seeing because they can't access the Chinese market with certain chips in the same way that they're tailored for NVIDIA. AMD does the same thing, and some of the more sophisticated chips they had managed to get into China now curtailed. But Lisa Su was really buoyant on the second half of the year. They got the MI4000, the latest and greatest AI accelerator chips and architecture coming out from them in the second half of the year. She's saying that is going to drive our fundamentals more broadly. Analysts have actually been saying, look, if you look at what's been driving revenue, it's actually average selling prices rather than perhaps taking away market share so substantially from an Intel. But they also, of course, had the pull forward effect of PCs, gaming looking relatively strong. And for Lisa Su, she's really just trying to talk up that AI infrastructure demand is resilient even in the face of some of these economic headwinds. We are anticipating a stronger year more broadly for AMD, and analysts have been too. But remember, this stock is down for the year and down hard.
All right, Caroline, always great to see you. Looking forward to Bloomberg Technology today. You can catch that at 11 a.m. But let's check in now on the happiest place on earth because Disney shares soaring pre-market after the company beat on its full-year profit forecast. The catalyst there were its parks business, also streaming. Joining us now, I'm pleased to say we have Chris Morangi. He is Gabelli Fund's co-chief investment officer. Chris, it's great to have you with us. A beat and raise from Disney. I think some on the street were interested and surprised to see this, given that a trip to Disney World is about as discretionary as you can get. As an investor in this company, how did you read what we learned this morning?
Well, it might be too much to call it a fairy tale quarter, but it was very strong. You know, a lot of, as you mentioned, trepidation coming into the quarter about the impact of macro on visits to the parks. Parks hit it out of the park domestically. Operating income up 13%. Now, you know, maybe it's too early for those macro concerns to bite. There is a long lead time in booking these trips, and people aren't going to cancel trips on their kids. But they, during the call, which is ongoing, they have pointed out they've had some strong bookings for the next 2 quarters.
In terms
of... You know,
Hey, in terms of the spend, Chris, I mean, how much longer can U.S. consumers or even global consumers keep up with Disney's rising prices?
Well, they have some very sophisticated pricing models, as you can imagine. They offer a number of different options for consumers. Listen, for many, many years, the U.S. consumer has surprised us with their resiliency, and that continues to be the case. And by the way, it's not just in the parks, but it's in other areas of the business, in streaming, which had a very good quarter, as well as advertising, which looks continue to be strong.
So a wild card for Disney. You saw shares slip last week along with Netflix after President Donald Trump announced plans to impose a 100% tariff on films that were produced overseas. There's still a lot of question marks around that. But Chris, I'm wondering, as an investor, how do you begin to approach a potential risk like that?
Yeah, a lot of questions, obviously, and not really a strong constituency in favor of those tariffs. So I think the probability of them actually coming to fruition are probably low, but obviously we have to take everything that the president says seriously. I think more broadly, obviously, this is one of the first attempts to actually tax a service, a non-physical good. So, I think the unfortunate outcome from that is that it's going to depress investment. And, before you fund a movie, you're probably going to want to know the answer to just how this tariff is going to work or if it's going to be applied.
Chris, I want to ask about Formula One. You cover Liberty Media as well. They had a tough comp because of the, fewer races in Q1 this year than last year. But what's your overall take on another consumer-driven business, right? I mean, it's a big spend to go to F1.
It is, and that's a little bit of a different consumer. That is a very high-end consumer that's going to the paddocks, going to these races. It's very global, as you can imagine. A premium good trading at a premium price. They've got a lot of dynamics. Hard to look at it on a one-quarter basis because of the race calendar. But, they are trying to buy this motorcycle race promotion called MotoGP. Very exciting. The EU has taken a harder look at that. So they have to get through that. And then we've got Vegas returning in the fall. And we've got a movie coming out, Formula One, Brad Pitt. That's going to stir a lot of interest, we think, globally.
Yeah, Brad Pitt also, by the way, narrated Hitting the Apex about MotoGP, which is a far more exciting motorsport. What do you think their odds are of getting that deal done, and what can they do with MotoGP?
Yeah, I think the probability of them completing that deal is high. I think they've met most of the concerns of the EU. And basically, you've got a blueprint in what Liberty did when they bought Formula One, basically improving sponsorships and promotion deals, et cetera. And you're right, it is, if you haven't seen it, very exciting. It's kind of made for the youth. They're shorter races with a lot of action, kind of made for the phone.
All right, Chris. Unfortunately, we have to leave it there. Always great to speak with you. Hope to do it again soon. That is Chris Morangi of Gabelli Funds. Meanwhile, check on these futures on this Fed Day. Happy Fed Day to you. You can see the S&P 500 giving up some of its pre-market momentum. It's still higher, but only by about 0.2%. You have big tech slipping as well, even though investors really cheered what we heard from AMD last night. The NASDAQ 100 still holding on to gains. For whatever reason, you have small caps outperforming this morning. A relatively quiet morning in the bond market so far, but we know that's going to change at about 2 p.m. today when we get that Fed decision and the conference to follow. Now coming up, Novo Nordisk rising on expectations that competition for its blockbuster obesity shot Wegovy will subside. We'll hear from the company's CEO next. This is Open Interest.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. context changes everything.
Africa has been silent in telling those global stories, and that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Today, the Fed decides.
It is the central banker's dilemma. Downside risk to growth, upside risk to inflation.
They are wait. This is a serious moment. I do not think the Fed can just sit on the side.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
They're expecting stagflationary-like environment.
They are going to be on hold until they have hard evidence one way or another.
Bloomberg surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
Let's get to high interest. Look at what's making headlines around the world. The Fed is expected to leave rates unchanged today, a move likely to frustrate President Trump. Officials have stressed recently that while uncertainty is unusually high, monetary policy is still in a good place to balance their goals of fostering maximum employment and stable prices. Bloomberg special coverage of the Fed decision begins at 1:30 p.m. New York time. And the dollar may face a $2.5 trillion avalanche of selling as Asian countries unwind their stockpile. That, according to Stephen Jen of Horizon SLJ Capital. He says the U.S.-led trade war may lead some Asian investors to repatriate chunks of funds or ramp up levels of protection against a weakening dollar, potentially triggering an exodus from the world reserve currency. Bloomberg's dollar gauge has dropped about 8% from a February high. And Weight Watchers is filing for bankruptcy. The company, known for its diet programs, once endorsed by celebrities like Oprah Winfrey, has struggled to compete with blockbuster weight loss drugs like Ozempic and Wegovy. The company did offer a few weight loss drug options on its platform, but found it challenging to convince clients that its programs were still worth their time. Katie?
Well, Matt, on that topic, Novo Nordisk lowering its outlook for this year, reflecting headwinds in the U.S. market. But investors are looking past that forecast and focusing on the upsides, mainly diminishing competition for its blockbuster obesity drug, Wegovy. Earlier today, I sat down with the CEO of Novo Nordisk, Lars Frogard Jorgensen, and asked about those diverging data points.
We are now in a situation where we can supply the demand in the U.S., and FDA has taken us off the drug shortage list, and that means that it's illegal to do compounding, so that has to stop. And that creates the opportunity for us to drive a bigger growth in the scripts for the legitimate high-quality product from Novo Nordisk. And when we lower the guidance for the full year, it is really because of what the impact was of compounding in the first quarter and probably also a bit into the second quarter. And we have a relative steep comparator in the second half of the year. So you should see this guidance as one of us really stepping up in the second half of the year and getting to more and more patients and really moving forward in a business environment with a much lower compounded share of the business, really down to the rare cases where personalized is really needed.
I also asked him about how he's preparing as President Trump threatens tariffs on the pharmaceutical industry.
It's one of those that's a bit difficult to predict right now because there are quite a number of different messages coming out. If you look at our manufacturing footprint, that's one of having invested significantly in the U.S. Specifically, we invested $24 billion in the U.S. Operations over the past 10 years. We have more than 10,000 people working for us in the U.S., and we actually produce and export more from the U.S. than we import to the U.S. So when other companies were moving manufacturing out of the U.S. to perhaps save tax, that was actually the time where we started dropping down and investing in the U.S. So we have API manufacturing in the U.S., we have fill-finish products, and when we talk about an all obesity treatment like Wegovy in a pill, that's actually 100% produced in the U.S. The API is made in the U.S., the tableting is done in the U.S., the packaging is done in the U.S. So it's really a U.S.-made product to Americans. So I think we have a good setup.
And that was my conversation with Novo Nordisk CEO Lars Fruergaard Jørgensen earlier today. And it's hard to overstate the impact of these drugs. Of course, the shares have struggled of Novo, but just the cultural impact. Just today, there was a story about how Weight Watchers has filed for bankruptcy due to these GLP-1 drugs. These drugs that Novo Nordisk and Eli Lilly have put forth, they've been the ultimate disruptor when it comes to healthcare.
Right. On the other hand, these drugs have really helped other companies like Hims and Hers, for example, or CVS, as they Novo Nordisk makes partnerships with them. It's interesting that during the shortage, U.S. compounding pharmacies were able to make copycat drugs, but that will no longer be the case after the end of this month.
Yeah, Novo really optimistic about that, saying that they're going to face reduced competition from those compounders, and as such, the second half of this year for them should be pretty big, but that remains to be seen. And it's a nice reminder that earnings season is still going on, and we have plenty of movers.
Also, I really need to fight for just one shot. Just one shot of these things. Some more movers on our radar. Arista Networks forecasts clouded by the tariff overhang. You can see those shares down 6.5%. So Supermicro offering a weak outlook. It sees customer delays. You can see those shares down by 6.5%. And Marvell, chip maker, delaying investor day and narrowing earnings guidance. Those shares almost decimated today. So a lot of concern in kind of the smaller cap AI universe.
Yeah, big time. And it's interesting to see Marvel see such a big decline. You do have AMD shares up a little bit. It seems like investors weren't very impressed by the outlook, but still, compared to how some of their peers are faring, not so bad. Now, coming up, we're almost 10 minutes away from the opening bell, and we'll begin today's trading day with Meredith Whitney. That conversation up next. This is Open Interest.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Well, some S&P 500 companies are under pressure due to U.S. consumer concerns. Goldman Sachs strategists note that earnings estimates for consumer discretionary and consumer staples have been slashed by about 8% and 4% respectively. That compares with 3% for the broader S&P 500. Let's unpack this all with Meredith Whitney. She is CEO of Meredith Whitney Advisory Group. And Meredith, it is fantastic to see you in person.
Thank you. It's great to be with you guys. It's been a while.
It has been. This is the first time I've met you, so it's really great to have you here. And I want to start exactly with this consumer because it feels like that's where a lot of the epicenter of concerns about the recession are right now. How long can the consumer hold up and whether this resilience that we're seeing is sustainable? And I wonder where you fall in that debate.
So I love studying the consumer. It's my favorite pastime because the data is so granular. But it's still really hard now. So the banks that reported, it seems like a year ago, but just 3 weeks ago, said the consumer was fine. And across the board, you go from prime banks then to some subprime lenders, they didn't really show much. But then you go into the quick service restaurants last week that said the lower end consumer they saw less foot traffic. And I look at Walmart numbers. One of my favorite functions on Bloomberg is ALTD. You get weekly retail data and foot traffic data, which is, so you don't have to wait a month to see the data. And Walmart had said that more of their consumers are high-end, more high-end is driving business. And the foot traffic is trailing spend. That's not the case with some of the lower-end, like dollar stores. But my point is things didn't fall off a cliff with spending. So the last data point is the last week of April, and things didn't fall off a cliff from spending. So it's down from the Easter week, but it's still positive. And so you'd think that if the consumer were really struggling, and look, over 50% of households have been struggling since COVID stimulus checks dried up. After-tax earnings in the year after consumer stimulus checks dried up were down on average 18%, right? Because COVID was non-tax. You've seen home equity rise at a faster clip than credit card lending. So people are tapping into the equity in their homes. And it's seniors, right? So 44% of home equity is taken out by seniors, which is counterintuitive.
It's crazy.
It's crazy, right? Yeah. So you see, I divide it into different cohorts. So the senior, which everyone thinks the boomers have all this money, that's a small portion. Seniors are living paycheck to paycheck.
Even though we hear from, we were talking with people who are saying $75 trillion is how much the baby boomers have. I think Ed Yardeni said that.
Yeah, and that aggregate number is correct, but only 1 in 10 seniors can afford assisted living. So they're staying in their houses. This is one of the problems with the housing inventory. They're staying in their houses longer because they can't afford to move out. And the problem is Invitation Homes that reported last week, and they're one of the larger single-family rental companies, said that their move-out to first-time buyer ratio was the lowest it's ever been.
All right, Meredith, we're going to keep you with us. Very excited to ask you also about any parallels you may see between now and the financial crisis. Meredith Whitney with us through the opening bell. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
All right, we are looking at futures that are slightly positive after a couple of down days, that 9-day rally coming to an end, but still hovering over 5,600 at the close yesterday. You can see S&P futures up 0.2%, NASDAQ futures up 0.1%, a little bit of AI chip maker weakness today, but it hasn't come through in NVIDIA, which is still unchanged, and that's very important. You can see the New York Stock Exchange here, FSM ringing the bell there, Fortuna Mining, and you've got Nextera down at the NASDAQ marketplace, Nextera, I should say, down at the NASDAQ marketplace. What we're really focused on today is consumer strength or weakness, right? Because we see in Uber a little bit of weakness maybe coming through, and in Disney a lot of strength.
Yeah, totally different story when you take a look at Disney. Surprising Wall Street with a beat and a raise, beating on earnings, raising its 2025 outlook on strong demand for parks and for streaming. You can see shares reacting in a big way here, Matt, up 10%. This has been a badly performing company, but totally different story, at least for this morning, at least right at the opening bell.
All right, Uber bookings missed estimates in the first quarter, citing issues like the LA wildfires, as well as what they said is worsening U.S. consumer confidence. Obviously, we've seen that come through in the soft data for sure, and economic uncertainty. And the shares, you can see intraday down 3%. So not as bad as we saw in the pre-market, but still down substantially. Of course, Uber has been up about 43% year to date. So it's been an incredible year for the ride-sharing company. We are back here at 731 Lex with Meredith Whitney, the CEO of Meredith Whitney Advisory Group. And Meredith, I spent so much time reading your research during the financial crisis. You called essentially that collapse, and Bloomberg dubbed you the Oracle of Wall Street. I had hair then. You look exactly the same. Do you see parallels between the great financial crisis and what we're seeing right now, what we're possibly at the beginning of?
I don't. And here's why. I think you had unemployment go to 10% during the great financial crisis. And I think unemployment goes 5.2, then 6.2, and that's from the retail sector and the hospitality and leisure sector. I think those get hit first, and you're going to see a cascading. The banks are in much better shape.
But you see 6% unemployment?
I see by the fall 6% unemployment. Wow. And the banks are expecting 7% unemployment, so they're prepared, and they've got so much capital. There are things that can mitigate that, but I'm not convinced that they're the priorities of the administration. It seems as if, my understanding, my expectations were that they'd focus on deregulation and tax cuts, and it's been tariffs. So people were caught by surprise. So it's different sequencing of how things happen. And so if charge-offs go to, I don't think charge-offs go to 7%, but I think consumer spending slows down materially. And if banks can outperform because they've got so much capital. If they relieve the regulatory capital constraints, they can do okay, but there's not a lot of demand. So what you see in consumer credit is people aren't spending. So credit card debt outstanding isn't growing that rapidly. It's up like 4%. So I think people are pulling back.
There's a lot to dig into there. I have to go back to 6% unemployment by the fall. Does that also translate into a recession? I mean, I don't know how you have a spike up to a 6% unemployment rate and not have a recession. And if that's the case, how do you position in that environment? What should investors be doing to prepare?
Well, I don't think a recession is priced into the market, and I don't think it's a deep recession. I think it's a mild medium recession. You had a deep recession after the financial crisis. That was, a year and a half in the making, or 2 years in the making, right? Because subprime blew up in 2007, and it just caught up with the big banks. The big banks will not be involved now, but the consumer,
they've learned their lesson,
which is already struggling, is going to struggle further, and that will relate into job losses. And I'm not like the 6%, 5-6% by the fall doesn't include what happens to ports and trucking, and I'm just focused on hospitality, leisure, and retail. And those are, I think, the jobs that get hurt the most are the Main Street jobs. And ironically, that's what the administration says it's rooting for. And it's just, there are going to be all sorts of unintended consequences that didn't happen. Like, people knew what they were doing before what caused the credit crisis. I think this is just sort of self-inflicted unintended consequences.
I wonder what the Fed does, because, I guess today we could hear kind of a hawkish tone from Powell, but this Fed, if we got to 6% unemployment, would cut drastically, wouldn't it?
I mean, they would cut. I think you're probably going to get 2 cuts by the end of the year.
Only 2 cuts.
I think so. I mean, 5%? What's the natural rate of unemployment? 6% isn't. I mean, it's still 40% less than a severe recession. So they'll be careful about sequencing this right. And the data is not, the data's on their side. They don't have to do anything. What they could do today is, what they did last meeting was take their foot off the brake of quantitative tightening. And that might allay the markets a little bit. But,
today, you mean today?
Today, they could do that. I'm not sure, obviously I don't know, like you guys don't know, but they're not going to do anything with rates.
Right. That seems to be the expectation. And just for those looking for context at home, the unemployment rate, as we learned last Friday for April, was 4.2%. So, as you say, 5-6% unemployment. When you take a look at the long-term average, it's not that dramatic, but certainly the rate of change, I think, would turn a lot of heads.
And for a generation of investors, that seems unreal.
Well, it has a lot. Look, it has implications. Just so many different stocks. And the way I get there, to explain, the hospitality and retail sector, unemployment went down 5% in the Great Financial Crisis. So you take that 5% and you get to 5.2, and then you add on if it goes to 10%, which it very easily could, right? I mean, there are retailers that are hanging on by a thread. That's to 6.2%, and that does not include transportation or a host of other industries. That's just conservative.
So there's a lot of potential pain coming. I mean, if you map out that environment, retailers, like you say, hanging on by a thread, in your words. Is there any sector, is there any particular industry that you think manages to do well, at least relatively speaking, in that sort of landscape?
I'll tell you what has held up well is grocery, because grocery is unaffected by tariff, and people are eating at home. They're not eating out. So grocery usually is a good recession investment.
It's a staple.
It's a staple.
I hope we can have you back soon.
I'd love it.
Been great to talk to you. Look forward to getting your research. Meredith Whitney, they are talking to us about her expectations. Let's get some more of the movers on our radar. for today's trade, AMD, Katie was mentioning, warning that China rules will hit revenue, and that clouds the outlook, but AMD is up 3%.
Yeah, I mean, you compare it to what we saw with Marvell and maybe investors doing a little bit of a pair trade there because it wasn't that bad when it came to AMD. Let's also talk about Arista Networks because tariff overhang obviously hurting that company and those shares today down about 8%. And then Supermicro Computer, Matt, issuing a weak outlook, sees customer delays. This is the story that just keeps on giving when it comes to Supermicro shares.
Yeah, absolutely. They provide a lot of fodder for the news. This is, though, still a $42 billion company. So it's a very interesting shop there, and it's right now down about 5%. Did I look at that?
I think you were looking at MSCI.
I was looking at MSCI. Sorry.
We're going to do
MCI, Supermicro Computer, is actually still a $19 billion company. So it's still pretty big for a company that had to say goodbye to any reputable auditors for a little while. Coming up, Barrick beats earnings as it continues its move into copper. We're going to speak with Mark Bristow, the CEO and president of Barrick, next. This is Open Interest.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Welcome back to Open Interest. A check on this market with green on the screen. The S&P 500 trying to break 2 straight days of losses. It is Fed Day, though, so everything can change at 2 p.m. when we get the decision, and then 2:30 when the chairman actually starts speaking. But at least for right now, across the board, green on these indexes. It's time now for our top calls, some of the analyst action in focus this morning. And we start with Wynn Resorts getting upgraded to a buy over at Bank of America. The analyst cites the opening of a new casino resort in the Middle East as a key catalyst that will help de-risk its China exposure. Next up, we have Marvell getting a downgrade over at Cantor Fitzgerald. The chipmaker cut its revenue forecast and postponed its investor day, citing an uncertain economy. Cantor analysts, for their part, worry about the lack of stickiness in Marvell's custom silicone business. Stickiness is a good thing here. Finally, Constellation Brands, it's the maker of Corona Beer and Kim Crawford Wines, just delicious, getting upgraded to a buy over at Truist. The firm says that investor cynicism on alcohol consumption is too high, Matt, and that investor sentiment on Constellation has bottomed. The shares higher by about 1.4%.
Wait, what's the cynicism on alcohol consumption?
They think that people are moving away from alcohol, I assume. Gen Z doesn't really like alcohol is one of the narratives that's out there.
What, because they prefer weed, or what's the idea?
I don't know. It just seems like Gen Z, they don't drink, they don't date the same way as people used to, and non-alcoholic options are really popular.
I bet they're going to drink. They're going to drink. Let them get a little bit older. All right, let's move on to actual gold right now. Barrick is one of the world's top producers. It posted higher than expected earnings this morning, and the surge in gold prices obviously helped the company raise cash as it continues to move into copper production as well. Joining us now is Mark Bristow, the CEO of Barrick. Mark, great to have you on the program. Obviously, you're in a good mood. We just were showing your shares there and the price of gold year to date, and it's been just a win-win-win for you guys. How long can this go on? I mean, are we, you think, peaking in terms of the price of the yellow metal?
Well, Matt, nice to see you again. The question is, can the gold price stay up at these levels rather than peaking? I think the answer is that it's more likely to stay higher than go lower at the moment, given the dynamics across the global economy, and that's what we're seeing. And on top of that, you know, our industry is ex-growth, so a lot of tightness in the supply side, some significant demand. I think the de-dollarization drive and the real focus on bullion has been the subject for the last couple of years, and I think we're now starting to see the investors sort of embrace the higher gold price, and that augurs well for equities who've been lagging for some time now.
Well, your ticker, your stock ticker is gold, which is one of the best tickers that's out there. But I want to talk about the copper business a little bit, because some of the commentary coming from Wall Street, from the sell side, was analysts noting that you had weaker performance at your copper mines, which was offsetting to some degree that first quarter earnings and revenue beat. Walk us through what's going on that side of the business.
No, Katie, we are expanding our copper business. I've always said that if you want to be a world-class global gold producer, you have to embrace mining copper, because the big deposits of gold left in the world today are what we call in geology porphyries, and that means they come with both gold and copper. And a classic example is the world-class Reko Diq project that we're developing in Pakistan, which is you know, a gold mine in its own right, as well as a world-class copper mine. And so that's our focus going forward. At the same time, we're privileged with 6 tier 1 gold assets within our portfolio, and now shifting to exploit some of these gold copper projects around the world.
What are your biggest costs, Mark? I have to imagine energy or fuel rank high up there for you, and I would guess, you know, at least in some places, you're competing with data centers or crypto miners. What are your biggest costs, and how do they look going forward?
Biggest costs are by far power, and as you know, the fuel prices come down, so there's that's softened. Of course, the world today, with its chaotic supply chain driven by this sort of very dynamic global economy, is a challenge. Second to power is people, And so those are the two big drivers. And recently, logistics has become a big challenge. I think it's become a big challenge for any industrial business, and how you manage the supply chain is important.
I also want to get your thoughts on M&A. Obviously, your shares are doing very well this year, as Matt highlighted. I know that you're selling mines as well, but when it comes to acquiring potential assets, is that something that you're looking at, M&A on the horizon potentially?
You know, Katie, I've been in this industry a long time, as you know, and M&A works at certain times in the cycle. It's tough to see M&A deliver value at the top of the cycle. We had a spate of mergers and acquisitions back in 2019, 2020. That built the foundation of Barrick. What we're pointing to now is the ability to grow organically. We're pointing to a 30% increase in what we call our gold equivalent ounces, so both gold and copper, out to the end of the decade, which is substantial. It's all organic. It's cost us about $10 gold equivalent ounce. And so that's really the way to go in mining, is when you can discover and develop and deliver organically and not have to pay a premium on a premium in the market.
Mark.
So we're in a great position, and we're tidying up our portfolio and really refocusing on tier one assets.
Mark, I want to ask you just quickly about something you mentioned at the top, de-dollarization. We have a story on the Bloomberg from currency analyst Stephen Jen, who says we could see an avalanche of sales, $2.5 trillion of reserves build up from mostly Asian countries. Do you talk to people who are looking to get rid of their dollars and would prefer to hold gold at high levels?
Yeah, I think, Matt, you know, it's a very important, and as a member of the World Gold Council, we're seeing this, is that some of the emerging markets, given the dynamics, global dynamics, some of the central banks, and it's been going on for a couple of years now, when I started out 30 years ago, very clearly the primary reserve in every central bank was US dollars. And what's happened is that many of the emerging market central banks, as well as the developing economies like Russia and China, have spent some of their dollar reserves to buy gold to balance their central bank reserves. And as you know, the gold price has gone up, so that's reinforced that behavior. So, you know, I think the view is that de-dollarization has moved a little further than everyone expected. Right. Although the US dollar is still a reserve currency, gold is becoming an important part of those reserves.
And that has certainly been to your benefit. Mark, great to speak with you. That is Mark Bristow. He is the CEO of Barrick. Now coming up, Disney jumping after beating estimates and raising its profit forecast. We'll take a closer look next. This is Open Interest.
up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne Ruhodern in Buenos Aires, Argentina, and this is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute financial and geopolitical news whenever and wherever it happens. I'm Francine Lacroix in Davos, Switzerland, and this is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what stocks are doing right now. The S&P higher after 2 days of declines, 56.22, the cash level. NASDAQ also gaining, but only 0.1%. We have kind of a mixed trade if you look under the hood. AMD is actually up and Supermicro down. We've had some negative news out of chip makers and out of the AI space, but as you can see, that results in a mix. Novo Nordisk is up after Katie's interview with Lars Kurgaard-Jørgensen this morning. Analysts, or investors, I should say, are optimistic about their chances when it comes to selling more Wegovy. Weight Watchers, on the other hand, is down. One driving the other into bankruptcy. Uber is off on disappointing consumer news, but Disney is up on positive consumer news. So there's, Katie, arrows going in both directions wherever you look.
Let's talk a little bit more about Disney, as you highlight, up 9.5% right now. We're joined now by Geetha Ranganathan of Bloomberg Intelligence. So a beat and a raise. I want to talk specifically about streaming, because in your preview note, you had written that Disney had gone all in on streaming, and looks like it's really paying off.
It's paying off big time, Katie. And we've seen that not just with subscriber growth, which they again posted a modest increase in their subscribers, and they guided to an increase in the fiscal third quarter as well. But more importantly, it has really been this whole turnaround story. I mean, just a few years ago, this company was losing about $4 billion on its streaming unit. And so far in fiscal 2025, in the first half, they've already posted close to about $630 million in operating profit, on track to meet their goal of well over $1 billion in operating profit. And it's not just the near-term outlook, right? It's like, as you look out the next few years, this is going to be a source of tremendous upside for them. I mean, it's 4% margins this year, but you look at Netflix and they're at 30% margins. So that's kind of what we're tracking to in the longer term.
Geetha, in terms of the president's intention to put tariffs on films made overseas, how do you work that into your model? Does Disney film a lot overseas?
They do, just like all studios. I mean, it's obviously they get benefits in terms of tax concessions, filming in different parts of the world. But, his post was just so cryptic, and there's just not so many details at this point. But even if you kind of look at, 100% tariff scenario, even in a worst case scenario, yes, it will have, a far-reaching effects, I think, not just for Disney, across the whole ecosystem. But again, remember, Disney is a very, very well-diversified company. If you just look at the studio itself, it's less than 10% of Disney's revenue. So I don't think it would be as onerous as, one might think at first glance.
All right, Geetha, thanks very much. Geetha Ranganathan there of Bloomberg Intelligence talking to us about Disney. Coming up, Treasury Secretary Scott Bessent is on Capitol Hill again. He's going to testify before the House Financial Services Committee, and we're going to bring you that testimony next. No doubt he's going to talk a lot or be asked a lot about tariffs and negotiations with the Chinese. They're going to meet in
Switzerland.
Neutral Switzerland.
Yeah, so he's been a busy guy. He was at Milken, now he's in D.C., going to Switzerland, and we'll track all of it.
This is Bloomberg Open Interest.
see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board.
I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Matt Piper. It is nearing election time for the most senior members of the Catholic Church. We are close to that secretive, centuries-old ritual known as the conclave for cardinals to pick a new pontiff.
I'm Seth Doan outside Vatican City. There is an air of excitement here around Vatican City, around St. Peter's Basilica, even among tourists who some find by chance they are here for a conclave.
I'm not religious at all, but I would say that it's still quite a historic moment.
The world will be watching, waiting to see if there's that white smoke or that black smoke, waiting to see what cardinals decide.
Today is the day a real ID is needed to fly domestically or to get into a government building. Transportation correspondent Chris Van Cleve.
TSA says the most important thing is to get to the airport extra early. Now, here at LAX, the checkpoints have just opened. They are moving. I would say that they appear to be going a little bit slower than they normally would, but people are getting through.
The Trump administration says 2 officials will meet with their Chinese counterparts to discuss trade in the coming days. But there are still many questions if trade deals will even happen, as our Nancy Cordes reports.
Over the last few days, he's been saying everybody expects all these trade deals to happen. Well, actually, we don't need any deals. I'll just set the deal. I'll set the rate because I am the shopkeeper and I am in charge. So it's a little unclear right now whether all these trade deals that the administration has been promising are coming are actually going to happen.
Following the 2-day closed open market committee meeting, Fed Chair Jerome Powell will announce whether interest rates will change. That is set to happen at 2:30 Eastern. Business reporter Jason Brooks.
Fed members have been insistent that they need more data on the impact of tariffs before making a move with interest rates, and members have been concerned about inflation remaining elevated.
Tensions between nuclear powers India and Pakistan are rising after India fired missiles across the border into Pakistani-controlled territory. It was in response to a recent terror attack. Dozens were killed. CBS's Arshad Zargar is in New Delhi.
India has been kind of mixed one. There have been celebrations in some Indian streets for what they said was a revenge attack on Pakistan. But at the same time, Indian security forces are very alert since Pakistan has said that they are going to have some kind of a response. So all eyes are on Pakistan to see what their next move is going to be.
A miniature dachshund named Valerie, who was lost for 18 months, about half her life on an Australian island, has been reunited with her owners. It was thanks to a wildlife rescue. This is CBS News. The Trump administration is poised to end a program many consumers have come to rely on.
It's the blue label on many home appliances.
If you need a new water heater, you've got to ask for one that's Energy Star certified.
Reports say the EPA plans to end Energy Star, the program that certifies the energy efficiency of home appliances. It's all part of cutbacks and reorganization at the agency. Back in March, the Chamber of Commerce and trade groups urged the EPA to keep Energy Star, calling it recognizable for consumers and saying its elimination could lead to decreased features and performance and increased costs. There's been no comment from the EPA. Steve Kathan, CBS News.
Idaho State Police say a pickup truck that collided with a tour van near Yellowstone National Park last week, killing 7 people, crossed the center line and hit the van. Police are still investigating what caused the driver to veer into oncoming traffic. Matt Piper, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are also streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast Live. That's where you'll find us. Busy day today. Around 10:25 today, we're going to take the Q&A down in Washington, D.C. Treasury Secretary Scott Bessent will be testifying in front of the House Financial Services Committee. We'll bring you that Q&A when it starts later this hour. It's also Fed Day, so there'll be complete Fed coverage this afternoon. Here in Bloomberg Intelligence, we're going to check in with Geetha Ranganathan. Disney reported some pretty good numbers, and they're opening a new theme park over in the Middle East in several years. So big momentum behind that stock. The streaming business doing better. Danielle DiMartino Booth, she is the CEO and Chief Strategist for QI Research. She is in our studio. We always like to have Danielle in our studio on Fed Day, get her thoughts of where this Federal Reserve is going to do. So busy day, we'll bring it all to you. And we're going to kick it off with John Tucker with a Bloomberg Business Flash. John.
All right, thanks, guys. And this market drivers report being brought to you by IBKR with a year-over-year change of the U.S. CPI. You see 2.6% in April of 2025 at IBKR forecast trader. The yes was recently at 26%. Start predicting today at ibkr.com/forecast. Last trading day for this contract is May 12th. Ahead of today's Fed decision, major stock averages for now are higher. And the parade of earnings continues. Best performing stock in the Dow Jones Industrial Average. You want to guess? Disney.
Mickey Mouse.
Yes, they forecast adjusted earnings per share for the full year that beat the average analyst estimate. Julian Emanuel of Evercore ISI, meantime, says it does remain a really tough environment for investors.
We do believe that you are going to, and it's obviously a difficult path, avert the recession, barely. But again, when we think about where the market is right now, there's that high level of uncertainty.
Right now, the S&P 500 up 26 points. That's up 0.5%, 56.33 on the index. The Dow Jones Industrial Average about 249 points. The NASDAQ 100 65 points higher. Steve Madden, ticker symbol SHOO, S-H-O-O, the latest company to pull its sales and profit outlook for the year amid the trade war. The shoe retailer forecasting almost 20% growth just a few months ago. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Alex.
All right. Thanks so much, JT. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. Market Movers is brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure for new U.S. customers with minimum financial commitment. Offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. All right, let's take a look at some of the stocks on the move today. I'm Alex Steele with Paul Sweeney, and we are joined by Bloomberg's Carmen Reinecke. Let's start with Weight Watchers. So interesting on a day where you have Novo stock up, and then you have Weight Watchers having to file again for bankruptcy.
Yeah, for sure. So Weight Watchers, its ticker WW, it also rebranded as WW International. Shares are down about 42% right now. The company said that it will file for bankruptcy after failing to compete with GLP-1 drugs like Ozempic. And this is interesting because Weight Watchers actually even tried to offer some of these drugs on its platform a few years ago. It really tried to sort of get behind this wave of weight loss. But it didn't work, so it's filed for Chapter 11. It's looking to restructure and cut about $1.2 billion in debt from its balance sheet. The proposal still needs to be approved by a bankruptcy judge. And this, I mean, 42% seems like a lot for this stock. It's fallen so much. It was over $100 a share, I think, in 2018 or 2019, and now it trades for, pennies on the dollar.
Wasn't Oprah Winfrey involved in this at one point?
Yes, she was. She was one of their spokespeople.
But I'm going to guess she sold her stock already. Okay.
TBD. We don't know.
Okay.
We can check it on the Bloomberg Terminal at
I'm looking at it right here.
Sure.
All right, let's go to Charles River. What is this company?
Yeah, so I actually was not familiar with Charles River Labs, ticker CRL, either, but it's a company that provides research, tools, and support services for drug discovery and development. So important, in getting new drugs to the market. Shares are up about 20% right now after it raised its profit forecast for the full year and reported better than expected first quarter results. Activist investor, which is also its largest investor. So we'll be working with them going forward. And Elliott has a great track record of boosting the stocks of companies that it's working with, both sort of on the day that the news is announced and even a year after.
Cool. All right. Mickey Mouse, what's going on?
Yeah, Disney is the top performer on the Dow today. Shares are up 9%. So the company reported results that were better than expected and also gave a boosted full-year guidance at a time when we've heard so many companies either cutting or just pulling them due to tariffs. One of the things that was doing well is the streaming business added subscribers even after they boost prices, so showing some strength there. They also announced that they are going to open this theme park in Abu Dhabi, which is a major tourism hub. And actually there is a Ferrari World, a Warner Brothers World, and a SeaWorld World park there.
Really?
So interesting.
Ferrari Park.
Yeah, Matt Miller.
Yeah, that piqued a lot of people's interest in this room.
So another thing that's interesting about Disney, so they said that they are going to be announcing more about this ESPN flagship next week, and that it also will not be called ESPN flagship.
Good. Can't wait to see. Plus is going to be in there somewhere. So, Carmen Reinecke, thank you so much. We appreciate it. Carmen Reinecke, equities reporter for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. Let's stay on that Disney story again. The stock's up 9%, although it is down 9% for the year. So they got some work to do there. We're going to go to the analytical side of this story. Geetha Ranganathan, she is the media analyst for Bloomberg Intelligence based down in Princeton. Geetha, you followed this company for many years. Have they finally turned the corner, and can they become a stock that most people need to own?
I think so, Paul. I think, this turnaround story has now been in the works ever since Bob Iger came back more than 2 years ago. And it looks like, everything that he's kind of put in place along with the CFO, Hugh Johnston, is really working. So they did raise guidance, for the full year. But it's not just that. It's just the conviction in the outlook as you kind of look out and build out the earnings model for the next few years. I mean, we are basically looking at them doubling their EPS from close to almost $6 this year to well over $10, $11 in the next 4 to 5 years. So just a lot of conviction, I think, now in their long-term growth trajectory with those new parks, with the added capacity, with the $60 billion investment, with, the Abu Dhabi park, new cruise ships. Everything seems to be finally kind of coming together.
Last quarter, though, the question was about their theme parks. Prices are too high, the consumer's pinched. There was a competitor opening up a park in Florida, and everyone was kind of worried. What changed in 3 months?
Yeah, so they did say at that point that, summer bookings were strong. Of course, nobody really believed them. But, when they kind of reported the numbers today and you saw that 13% increase in operating income in the domestic parks are really the bread and butter of, the Disney theme park business, makes up 70% of revenue, then that has really managed to, I think, allay fears. And they, it's not just what they reported, Alex, it's what they said for the remainder of the year. So they said bookings are up this quarter 4%. They said advanced bookings are up for the fiscal fourth quarter 7%. And that is with that new Epic universe coming on board. So still demand seems to be really resilient. It seems to be strong. Even though there's a little bit of softness internationally, domestically, they seem to be in very good shape.
So, Geetha, talk to us about the profitability of their streaming businesses writ large here. How profitable are they? Do you think they can approach the profitability of, say, Netflix?
I think they can. Over time, they definitely can. So this year, Paul, we're looking at just over $1 billion in operating income. On a $25 billion in revenue, that's about 4-5% margins. But really what we're looking to, the North Star here is definitely Netflix, as you just pointed out. Netflix should get to 30% operating margins this year. So that's really what Disney is working towards. So even as we kind of build out, or we look at the earnings trajectory for that streaming unit over the next couple of years, I mean, we look at them getting to, 15-16% margins over the next 2 to 3 years. And then, of course, a lot more upside with, the pricing power, with subscription growth, with password sharing, with, their advertising build out. So they have a lot of different levers that they can pull as well.
Is the goal to catch up with Netflix in terms of streamer subscribers? Is it about profitability? Like, what's the goal there? Because Netflix is so far ahead just in basic numbers.
Netflix is absolutely far ahead. And there's no doubt about that, Alex. They have well over 300 million subscribers just in terms of scale. Disney has about 125. So there's 125 million. So there's a lot of catching up to do. But there is one area where Disney is far ahead of Netflix, and that's advertising. They have a very, very good advertising infrastructure. And this is an area that Netflix is kind of really struggling with. And then remember, Disney has a big weapon that they can use with that ESPN. It's not going to be called flagship, I know, but with that ESPN streaming launch coming a little bit later this year, they have, they're spending something like $11 to $12 billion in sports rights that they are going to monetize from a streaming perspective. So that is where, they're going to have an unrivaled streaming product, even when you compare it to Netflix, because they're going to offer you entertainment, they're going to offer you sports, there's going to be something for everybody. So it's going to be, I think they can, I'm not sure if they're going to completely be able to match Netflix in terms of subscriptions, but they're going to be able to get to that profit number, I think, pretty quickly.
Keith, if I'm an investor in Disney, do I just kind of write off what used to be the core business, which is the cable network business, and just say, it's in secular decline. I'm focusing more on the growing streaming business. Is that kind of the play?
That is the play, Paul, and that's across majority of the space. So, yes, it's just kind of, humming along, if you will. Advertising is a big concern there. Affiliate fees, again, is in secular decline. We know other companies are actually trying to separate out their cable networks business just because it's been struggling and the outlook doesn't look good. Comcast actually is separating out its cable networks a little bit later this year. They even have a new name for that new business. And we kind of expect WBD, Warner Brothers Discovery, will do something similar. But yeah, I think it's pretty much, at this point, it's pretty much written off, Paul. The linear networks business is dying.
All right, Geetha, thanks a lot. Really appreciate Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. media on Disney earnings. Just for an update here, Treasury Secretary Scott Bessent is currently testifying before the House Financial Services Committee. We will bring that to you live when the Q&A portion starts. Bessent is currently reading his opening statement. All right, well, yesterday he kicked off meetings on Capitol Hill, starting with the House Appropriations Committee. While answering questions in front of the House Appropriations Committee yesterday, he did warn that his department is on the warning track towards exhausting its capacity to stay within the federal debt limit.
We will share with Congress when we believe we are approximating that date. So that will be forthcoming. But I will tell you, just as an outfielder running for a fly ball, we are on the warning track. And when you're on the warning track, it means the wall's not far away.
Clearly, I don't know what a warning track is. But now, for those of you, I hope you do know.
We had that conversation off air during that.
We did?
With visuals.
Oh, we did, right
Yes,
now, yes. And then John Tucker was pretending he was in the outfield. It was a whole thing. So now we got that. All right, well, joining us now in studio to discuss and also look ahead to Fed Chair Jay Powell later on today is Danielle DiMartino Booth, CEO and Chief Strategist of QI Research. Lots to get through. Just to start on what we're going to see in Capitol Hill, any key things that you're looking at, maybe if there's something other than a sports reference?
Well, I think that there's likely to be more discussion of the X date. In fact, I think that one of the reasons that that Powell was seen, at least by his Chief Lieutenant Christopher Waller, as being more preemptive in reducing quantitative tightening was because of the unknown of how quickly this X date is going to creep up on us. So at least the Fed is in a position to not be pulling too much liquidity out of the system as we approach this kind of due date, if you will, for the financing of the country. So I think he'll be pressed on that further, as well as on the nature of tariffs. And yesterday there was quite the back and forth, and a contentious one at that, between one of the members of Congress and Bessent about, isn't a tariff a tax to the consumer? And Bessent kept pushing back and saying, it depends. We will find out. So
if you're Fed Chair Jay Powell, can you wait and see how it plays out? Or do you have to get a little preemptive? Because I'm not sure if you're a hard data or soft data kind of person, because they're kind of telling two different stories a little bit.
Well, actually, Torsten Slott put out a great chart a few days ago that shows that there's a record disparity between what the soft data and the hard data are showing if you're looking through the prism of the unemployment rate and U.S. households' expectations for rising unemployment in the next year. We've never seen this kind of a disconnect. And we unusually have 6 Fed speakers out of the gate on Friday. I mean, it is a deluge of individuals. And most of them, right before blackout, were starting to say, we're going to have to pay closer attention to the risk for rising layoffs. We need to pay attention to some of these sentiment surveys. All Americans can't just have something in their mind. They have to be seeing something on the ground. And in fact, if you look at the beginning of the month of May, you were just talking about Weight Watchers a few minutes ago, for the entire month of April, BCY Go on the terminal had 7 large bankruptcies. So far this month, we've had 6, plus 1 massive strategic default. Office Properties Income Trust, S&P downgraded them to strategic default as tantamount default yesterday, $2.14 billion in liabilities. But we've effectively seen 7 in early May, whereas we saw 7 for the entire month of April. There's fallout when we start to see these bankruptcy flows, and household bankruptcies in the month of April were up 16% year over year. That's according to U.S. bankruptcy courts. That's hard data.
Yep.
So you've been concerned for a while. How much more concerned are you now than maybe you were 3 months ago? And what is an appropriate policy response?
So whether you're looking at Macro Edge or the long-term provider of layoff announcements, Challenger Grain Christmas, after the Department of Government Efficiency layoffs kind of worked their way through the data February and March, all of a sudden, boom, we still had 100,000 layoffs in the private sector announced in the month of April. I think that this is relevant. I think we are going to see a pop. Anna Wong agrees with me that the damage that's been done in transportation, logistics, warehousing, that we're going to see that show up before the Fed meets again on June 18th. Just, to say nothing of higher layoffs coming from other channels.
All right, Danielle, we're going to go down to Washington, D.C. Thank you very much for coming to our studio. Important day here today, the Fed Day. Danielle DiMartino Booth, CEO and Chief Strategist, QI Research. We always love chatting with her on Fed Day. Let's go down to Washington, D.C. The Q&A is the beginning of Treasury Secretary Bessent as he testifies before the House Financial Services Committee. Chairman French Hill is asking questions at this point. Let's go down to Washington.
The World Bank should make that a key.
Mr. Bessent is speaking at the moment.
Thank you. I also referenced my work over the past 5 years with the Treasury and others about IMF reforms. You also referenced that in your talk. Recently, the IMF shareholders agreed to a quota increase, and I appreciate the agreement that this agreement does nothing to increase the voting power of China or Russia, but were Congress to approve this agreement, it would allow future administrations to greenlight more general special drawing rights allocations close to $1 trillion. And that would mean $60 billion of new unconditional liquidity for the Chinese Communist Party, $25 billion for Moscow, and $7 billion each for the regimes in Caracas and Iran, with no sign-off from Congress. So even if rogue regime FDRs are rejected by Western countries, which we've seen in the case of sanctioned countries, they still could be exchanged behind the scenes for Chinese RMB, for example, and I believe this is unacceptable. Would Treasury, under your leadership, work with me to reform the SDR allocation process at the IMF?
Mr. Chairman, we believe the SDR process at the IMF should serve the goals of the United States of America and not other states. And as I said in my speech during IMF week, this administration is aligned with you in your goals on the SDR. And furthermore, we believe that the IMF needs to get back to basics in working with countries when there is a market failure in financial markets rather than helping large, well-financed countries.
Thank you. Well, we look forward to following up with you and walking through this. It won't be an easy task, but with international leadership from the United States, I think we can get there, and I think we will all benefit. And that means countries in trouble will benefit instead of just a general allocation approach. The president, since he's been in office, has championed high-profile investment issues revolving China. As everyone knows, he's been negotiating U.S. investors' acquisition of control, for example, over TikTok. In his State of the Union address, President Trump announced a major investment would see Americans take control of 2 ports near the Panama Canal that are currently owned by a Hong Kong-based business. I'm concerned that recently established outbound investment restrictions could make deals like this even more challenging. Under the regulations, U.S. investors don't actually know which companies are off limits, and Americans face bureaucratic hurdles if they want to take control from Chinese owners. What are your views on revising outbound program to change this? Since the president wants strategically to see American investors take control perhaps of some Chinese-owned entities, how do we make sure we get outbound rules right?
Mr. Chairman, I want to thank you and the members of this committee for leadership on this. I had a very good discussion with 2 members yesterday where we talked about the importance of establishing either red light or green light and not having a yellow zone for outbound investment. The outbound investment security program is an important national security tool in our effort to restrict the PRC from exploiting the benefits of U.S. investment. We've been receiving notifications from the outbound program. We're monitoring the market, and we're trying to ensure that the investment community is aware and familiar with the program. We appreciate the interest from Congress, and while legislation will be important and helpful, we would like a bit more time to process, including the work mandated by the President to inform legislation.
I appreciate that. We look forward to working with you. I yield back and now turn to the distinguished ranking member of the committee, Ms. Waters, for 5 minutes.
Thank you very much, Mr.
You're
Chairman.
listening to Maxine Waters. The House Financial Services Committee is now questioning Treasury Secretary Scott Bessent.
No, ma'am. We actually met one New Year's Eve in the Bahamas. And I was...
He didn't make an impression.
Why
don't I remember that?
Well, you were much better at the electric slide than I was. And I was with the Prime Minister of the Bahamas yesterday, Prime Minister Davis, who sends his regards.
Well, were you with my husband when he was the ambassador to the Bahamas appointed by Clinton?
So.
Well, you're not going to like this. And so this is the first... I didn't remember that, but that's odd because you've been at Treasury and I've sent you 5 letters to ask about what was going on under your leadership and only received a couple of cursory replies from your staff. Why don't you respond?
Ma'am?
I guess you don't know why you didn't respond. Secretary Bessent, you worked in finance before, right? You will find bipartisan support on this committee for small businesses and the institutions that finance them. I worked with Trump's first Treasury Secretary to pass $12 billion in support for community development, financial institutions, and minority banks and credit unions. So I was surprised when Trump first tried to eliminate the CDFIs, but it caught you by surprise also. You said that the CDFI fund plays an important role in expanding financial access. Unfortunately, you were not very persuasive last week. Trump proposed to basically cut all CDFI funding. Now, let's discuss your job before becoming secretary. Your hedge fund had a secret sauce for how you would make money for investors, a proprietary trading strategy. As CEO, you guarded that strategy. You never allowed unrelated persons to access your firm's computer records, data, personnel files, and algorithms, right? And I'm sure you wouldn't have allowed just anyone unfettered access to copy, change, or to use those records, right? I suspect not. And that makes good sense. What doesn't make good sense is why, as Treasury Secretary and acting CFPB Director, you would allow Doge unfettered access to the government system that handles trillions of dollars in payments to the proprietary business records of entities regulated by the CFPB, or most alarmingly, to the tax records of hundreds of millions of Americans. But you still threw up the gates of our finance system open to Elon Musk and his band of 22-year-olds. Yes or no? Do you know the level, type, or nature of the clearances and security training required for individuals to access the information held in the computers of Treasury, IRS, or CFPB?
Yes, I do, and I think we would have a disagreement over the definition of the word unfettered.
Mr. Secretary, did all the individuals working with Doge who were given access to Treasuries and CFPB's computer databases receive all of the required clearances and security training before they were granted access?
Again, they were granted read-only access at Treasury. There were two.
So let me just say,
Doge employees.
Please, you can't filibuster here. This is not the filibuster playground. And so what you did was you let these strangers into our Treasury with access to all of the data, all of the personnel information, and you just opened the door. Why'd you do that?
No, ma'am. They were Treasury employees.
Oh, are you saying today in front of this committee that all of them were Treasury employees, that the 25-year-old who's being identified, who worked for Elon Musk, was allowed into the Treasury? Was that person there?
He was a Treasury employee, as was Tom Kraus, the senior person on the Doge team. There were only two people.
There were Doge employees also.
Sorry?
Do you know, were you aware that there were Doge employees coming into our treasury getting all of our personal information?
Well, ma'am, there is no such thing as a Doge employee. There were Treasury employees.
I tend to disagree with you based on the information I had. Has any information been downloaded by anyone working with Doge from any of Treasury's or CFPB's computers? Answer yes or no.
Not to my knowledge.
You better learn.
Gentlewoman yields
Yield
back. The gentleman from Michigan, the vice chairman of our committee, Mr. Heisinger, is recognized for 5 minutes.
Thank you, Mr. Secretary, for being here. And I just have to note that it's
All right,
ironic
listening
that this has
to
been
Senator
declared
Bill
a no filibuster
Heisinger
zone by
from
the
Michigan.
same people who walked out of a hearing yesterday in filibuster. So, and just to give you one quick brief moment, are you saying that there was no unauthorized or unsanctioned persons that had access to the systems that you are in control of?
Again, there were two employees.
Yep.
There were very strict guardrails, and they were there for an ERP function.
Yeah, so they were authorized and they were sanctioned.
Yes.
So not unknown, and Elon Musk wasn't one of those two people?
No, to my knowledge, Mr. Musk has never been in the Treasury building.
Okay, all right. I have to hit on Burma and a little crypto, and if we have time, China. So I want to thank you for your actions that Treasury took this past Monday regarding Burma. The KNA, the Karen National Army, has become a haven for transnational criminal organizations that run illicit operations such as human trafficking and smuggling. The group has strong ties to the Burmese army, which has targeted religious and ethnic minorities such as the Rohingya since the civil war broke out in 2021. While the U.S. and our allies continue to impose sanctions against the military junta, unfortunately, the atrocities continue. My district, the 4th District of Michigan, is home to approximately 5,000 of these ethnic Burmese. And I'm just asking you, we need to do more to protect the people of Burma and to stop the genocide. Yesterday, I reintroduced the Brave Burma Act, a bipartisan piece of legislation that would require the president to determine on an annual basis whether to impose stronger blocking sanctions against the Myanmar oil and gas enterprise, the Myanmar Economic Bank, and foreign persons operating in the jet fuel sector of the Burmese economy, which has been a tremendous amount of their revenue. And it further limits the junta's ability to borrow at the IMF, which I think is one of the issues that the chairman was touching on. So these actions would target the heart of the military junta's revenue. So can I get your commitment that you're going to continue to work with my staff and us on a bipartisan basis as we try to address these issues in Burma?
Congressman, we're happy to work with your staff on this legislation, and thank you for your leadership on this issue. I share your concern about imposing consequences on persons who threaten the peace, security, and stability of Burma. Treasury has tools to continue to take action for the people of Burma, and working with you, we will continue to do so.
That's great. And what's frustrating is while some of these sanctions have been put in place, a sanction's only as good as the willingness to enforce it. And we have seen them receiving financial support, the junta, from around the world, especially, frankly, as they ramped up production during the last administration. So I'll note it's not just Burma, it's places like Iran, that this illicit activity that has gone around the sanctions has been allowed. In some cases, Treasury has granted these licenses. I sit on the Foreign Affairs Committee as well, and we see this all the time. I want to touch on crypto. Yesterday, as I had mentioned, the committee held a hearing with House Agriculture, or attempted to hold a hearing with the House Agriculture Committee. Turned into a very important roundtable as well regarding digital asset market structure reform. So can you quickly explain how important it is for America to take the lead here, especially as we see China leaping ahead?
Yes, sir. We believe that the United States should be the premier destination for digital assets And as members of this committee and the Senate are attempting to do, create good market structure around that, so that U.S. best practices are used around the world.
And that's really the point, right? Is having American U.S. best practices to sort of set the pace for others to follow, rather than us trying to fill in the holes that others that may be created as others set that pace.
Yes, sir. And also, the digital assets are an important source of innovation that will drive that can drive usage of the U.S. dollar around the world, as with stablecoin legislation. There is speculation that there may be up to $2 trillion of demand over the next few years for U.S. government securities from digital assets.
My time has expired, but I'll send you my question regarding Chinese debt trap diplomacy. So with that, I yield back.
Gentleman yields back. The gentleman from New York, ranking member of the Small Business Committee, Ms. Velasquez, is recognized for 5 minutes.
Mr. Chairman, I want
You
to raise
are listening currently to Congresswoman Nadia Velasquez from New York, questioning Treasury Secretary Scott Bessent in the House Financial Services Committee.
I would like for the witness to be swearing in before I ask my questions.
The chair doesn't see a need for that. You may ask your question. Your time can start the gentlewoman's time over at 5 minutes.
Secretary Bessent, you were on CNBC earlier this week making claims saying we are very close and maybe we will see some deals this week on tariffs. So tell us, tell the American people, tell small businesses and consumers, tell retirees, specifically, which countries are you close to striking deals with?
I'm sorry, Congresswoman, but that would not benefit the United States.
No. I'm asking you a question based on the statement that you made on CNBC.
And I am telling you that it would be detrimental to the interest of the United States for me to answer that question.
Why will that be detrimental?
Because as the negotiations may still be in process as we speak, as we are not at the end of the week yet, I am sure that you through your question, would not want to compromise the U.S. negotiating.
Reclaiming my time.
Would you?
Secretary Bessent, the president goes into a press conference and claims that there are negotiations going on. And then the next day, there's no negotiations going on. So why would you not answer my question? And that will be considered detrimental to the American people, to the American economy. I do not understand. Despite your claim...
I'm happy to say there are negotiations going on. I'm not going to reveal the details.
No filibuster. No filibuster here. So how long do you think those negotiations will take before they are concluded?
There are numerous countries, as I have said, if you saw my CNBC interview, which you referenced, that there are 18 important trading partners, and we are moving forward at all deliberate speed with those.
Do you consider these negotiations advanced negotiations?
Some of them are quite advanced.
So you expect this deal to be more than memorandums of understanding? You expect them to be full negotiated trade deals?
I believe that they will be the agreements in principle, and then we will paper them over in the coming months. But once we reach an agreement, then I am sure that the other countries will live up to it.
Okay. In congressional testimony yesterday, you said the U.S. has not started negotiating with China on tariff reductions. Does that continue to be your position, yes or no?
As you may have read...
Yes or no, sir?
As you may have read in the press, I will be going to Switzerland, and the negotiations will begin on Saturday.
Okay, so the president told you that that will be your answer today. So can you tell who from the Trump administration is engaged in those discussions
Which discussions?
with China?
Trade discussions?
Pardon?
I'm sorry.
Trade discussions, yes, sir.
Well, the trade negotiations will be led by myself and Ambassador Jameson Greer,
And,
USTR.
and what about Pete Navarro?
Sorry?
Peter Navarro.
He will
Is
not.
he-
He will not be joining us in Geneva.
Thank God for that. Are those negotiations considered advanced?
Pardon?
Are those negotiations considered advanced?
As I said, on Saturday we will begin, which I believe is the opposite of advance.
Secretary Besson, as Treasury Secretary and a senior member of President Trump's economic team, has President Trump given you the authority to finalize any trade agreement with China or any other trading partner?
As President Trump has stated, he will have the final decision on any trade agreement.
So you're telling me all of these increased prices, the stock market losses, the production delays are all based on the wins of Donald Trump, that you could strike the best deal with Canada, Mexico, or even China that is completely in our favor, giving us everything the administration
Gentlewoman's
is
time has
seeking.
expired.
And if President Trump decides at any certain moment,
Gentlewoman's time is
for whatever reason, not to take the deal, that will be it. I yield back.
The gentleman from Oklahoma, Mr. Lucas, who is chair of our Task Force on Monetary Policy, is recognized for 5 minutes.
Thank you, Mr. Frank Lucas, a representative from the state of Oklahoma, speaking to Treasury Secretary Scott Bessent in the House Financial Services Committee.
Can you give an updated assessment of those events, and how would you characterize the functioning of the market during that period? During the dust-up in Treasury markets?
How the market was very well functioning. It was volatile, but the underlying infrastructure worked quite smoothly, sir.
Does the Treasury Department have the tools necessary to address market volatility? You've said you may increase the use of the buyback program. Are there other authorities that might be helpful to address the challenges of the market?
Yes, sir. We have a very large toolkit that we can deploy, as does the Federal Reserve.
Taking a step back, Mr. Secretary, can you provide us with a sense of what regulations the administration is working on to bolster resilience in the Treasury market and the timelines when you would expect those changes to be announced? This is a core issue on the task force I and a number of my colleagues are working on.
Sir, the auction sizes, the current issuance sizes leave us well positioned to address potential changes in borrowing needs. I can tell you that investor participation in auctions, there's been broad investor support. Our weighted average maturity is about 61.2 months, which is quite fulsome. And we have implemented a buyback program with two objectives: liquidity support and cash management.
One last question along that line. I've long said that the administration should look at reforming regulations like the supplemental leverage ratio to relieve some of the constraints that market participants are facing in the Treasury market. I hope you'll consider looking at that.
Sir, Treasury does not look at that, but I believe that it is a high priority for the three regulators, the OCC, the FDIC, and the Federal Reserve.
Thank you. And as the SEC continues to implement their clearing rule, a number of firms, including those outside the United States, are looking to provide clearing services for U.S. Treasuries and their derivatives. How are you working with the SEC and the CFTC to ensure the integrity of the Treasury markets as these firms look to intermediate?
Sir, the Treasury market is a global market, and we welcome new participants, and we want to make sure that best practices employed in the U.S. are also employed globally.
And the reason I ask that is, and if you could specifically comment on the clearing of U.S. sovereign debt outside of the United States, what risk could that potentially present. And I come at that from the perspective, if there's a challenge in the market, if it's a U.S.-based entity, then the regulators who would make the difficult decisions are here. If it's outside of the United States, they might have a different perspective.
We are constantly studying that, sir. As of now, we do not believe that it presents a risk, but I will, as we continue our studies, I will have my staff interact with your team.
Absolutely, Mr. Secretary. And one final question. Primary dealerships has become an expensive proposition for firms, which in one explanation for participants leaving the market, it's one of the many explanations. Should we be looking at ways to make the environment friendlier to investors wanting to become primary dealers?
Sir, we saw at the recent auctions very low participation by the primary dealers, which tells me that there may be the regulatory function there that is preventing them from using their balance sheet for the benefit of the U.S. Treasury.
So clearly the task force that Chairman Hill was kind enough to set up and yourself, we have work to do. Thank you, Mr. Secretary.
Would you yield?
I would yield to the gentleman from Michigan.
Thank you, and I can get my China question in, so I appreciate my colleague doing that. I want to talk a little bit about the international financial institutions, the IFIs, such as IMF, World Bank, and they're falling short of addressing key challenges.
Of the House Financial
China,
Services Committee, representative from Michigan.
Debt trap diplomacy. How should the IMF really help borrowers take the fund's advice when it keeps giving China a free pass?
Well, Congressman, as I said in a public interview after one of my IMF speeches, it is time for China to graduate from developing country status. It is the second largest economy in the world. They are a large, important economy, and they should no longer be granted the status of a developing economy.
I'd like to invite you, Mr. Secretary, to continue that answer in writing, and I thank the Vice Chairman and Mr. Lucas. Let me call on the gentleman from California, the ranking member for our Capital Markets Subcommittee, Mr. Sherman.
First, a parliamentary inquiry. Since the last speaker had an extra 30 seconds, can I have an extra 30 seconds?
Right. Mr. Chairman already insists that you give the extra 30 seconds to the next.
I would be happy to do that.
Mr. Chairman, I agree with you that special drawing rights should be increased only with congressional input, and I agree with Mr. Huizinga that we have to focus on Burma, Myanmar. I ask unanimous consent to put in the record a chart showing how the value of the dollar compared to other currencies has declined precipitously since Trump's so-called Liberation Day, and to also put into the record a CBO report issued just an hour ago that shows that Republican proposals to change Medicaid would in one case take 1.5 million people would lose their Medicaid benefits, and in another proposal would cost 3.9 million Americans their Medicaid benefits.
Without objection.
Also ask unanimous consent to put in the record a letter I sent to the Secretary, responded to by his Assistant Secretary, dealing with direct file, which means you don't have to pay TurboTax because the IRS has the software. And the response that I got, an absurd response, was basically, well, as long as, we just want to make sure TurboTax makes a lot of money, so we're not going to do that. And I would point out that the IRS could send every American, for their voluntary use, a proposed first draft of the tax return, since you already have the W-2, you already have the 1099, and you don't have all the input errors that come from people doing their own returns. But that is something that your administration is stopping. I would ask you, Mr.
Without objection.
Yes. I ask you, Mr. Secretary, to provide for the record